continuing to try to refine the cost basis. They, as you saw, last week, I believe they exited close to 50 of their health centers. So I think it's just sort of their annual, looking at their cost base and trying to be prudent.
Chuck, you've alluded to this. The stock is up by close to 5% this morning. Talk to me about the kind of characteristics I inherit when I buy this name and put it in my portfolio. Typically, we talk about this name as being somewhat defensive. I've noticed in your research you've talked about the offensive characteristics that come with Walmart as well. Could you build that out a little bit, Chuck?
Yeah, I mean, I think for the past 20 years, Walmart's been a very defensive name. So when times get tough, investors will flock to Walmart. I think the model's changing. I think the business mix with advertising, data, marketplace. Obviously, we just talked about them trying to attack more higher income customers. So it's changing to a degree. It's balancing out, which I think is nice. It kind of reminds me of Costco. I mean, Costco, we talk about having both offensive and defensive characteristics, and I think Walmart's starting to get there. And you're seeing it in the multiple now, close to 25 times. And one thing we haven't talked about today is their traffic. The traffic was up close to 4% on a 2-year basis, actually accelerated relative to the fourth quarter. And traffic's the proxy for a retailer's health, and they had a great quarter.
Chuck, you mentioned Costco. Is this something you're seeing across the discount retailers then? Are they all moving in this direction?
There's a lot of similarities here between Costco and Walmart, both on the top line and on the bottom line. Inventory control, both, and then I think the common denominator between both is really price and value, and they're leading in both, and that's paramount today. It's paramount always, but particularly right now when consumers are really frustrated with inflation, their ability to win right now is evident.
Chuck, before you go, top pick at the moment, what is it?
We still like Dollar General. I think their turnaround. We highlighted last October when we upgraded it. We think they'll have a good first quarter. We think there's a lot of debate in the stock. We like the risk reward here. But don't get me wrong, we still like Walmart. We still like Costco.
Appreciate the update, sir. Thank you. Chuck Grom there, Gordon Haskett, following Walmart numbers with a stock higher now in early trading by more than 5%. Go through the picks there. Dollar General likes Costco, likes Walmart. I think that speaks to the macro backdrop of the moment for Gordon Haskett.
People are looking for discounts, and they're finding them at certain places, even people who have more disposable income. I'm just really curious to dig under the hood to understand how much some of these efficiencies are driven by, say, machine learning, how much is driven by trying to adapt more of an e-commerce type of model, and what the barrier to entry is for companies that are not that big. In other words, do we start to see an acceleration of the retailers that don't have access to that type of advancement?
They beat on the top and bottom line from Walmart a little bit earlier this morning in the last 40 minutes or so. Let's get you an update on stories elsewhere this morning. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. U.S. CPI data was accidentally published 30 minutes early yesterday. There's no obvious sign that the early publication moved markets, but the Bureau of Labor Statistics said it is launching a full investigation. It's not the first time that BLS data practices have come under scrutiny. About a month ago, Bloomberg reported that a BLS economist corresponded about CPI components, answering numerous questions with numerous Wall Street firms, including JP Morgan and BlackRock. And 2 brothers who studied at MIT have been charged with stealing $25 million in 12 seconds by exploiting a weakness in the Ethereum blockchain. Federal prosecutors in Manhattan have charged the brothers with fraud and money laundering over a heist that occurred about last year. The brothers allegedly spent months planning that scheme, studying trading behaviors and setting up shell companies. And world #1 golfer Scottie Scheffler is the favorite as play gets underway at the PGA Championship in Valhalla. Scheffler has won 4 of the past 5 tournaments he's appeared in, including the Masters last month. He'll face competition from the likes of Rory McIlroy. He's hoping to win his 5th major and his first since 2014. And that's your brief, John.
Danny, thank you. One just had a baby, the other just got divorced. Plenty of drama in the world of golf going into the weekend.
This is where you have the segment where Jonathan Farrow talks to you, the viewer, because he knows that you probably cannot talk to Emery or myself with any knowledge whatsoever.
Everyone who's glossed over the sports pages knows about Rory's love life in the last couple of weeks,
I know. It's like the...
I'm just excited about Happy Gilmore, too. Isn't that a golf movie?
I saw that.
Yeah.
I saw that's coming out, yes.
That's my knowledge of
Mr.
golf.
Sandler making a sequel. Very cool.
Crushed it.
At least you've got an interest. Okay. Next on the program, jumping from data point to data point.
We've had 3 low 0.4 CPI monthly prints, followed by a 0.3. You wouldn't want to over-interpret any of this. They'll need more information. The market is going to be just waiting for the next data point before it does anything else.
The next CPI report, June 12th. For anyone interested in the calendar, that's the same day as the Fed decision, so that's going to be a very interesting day. Equity futures right now positive by 0.1%. Live from New York, this is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power.
This is Bloomberg.
Equity futures on the S&P 500 positive here by 0.1%. Bond yields going nowhere, 433.61. There were two events on the calendar this morning. One was Walmart, beat on the top and bottom line. Their stock is up by more than 5%. The next one is jobless claims, coming a little bit later this morning, 45 minutes away. A rare upside surprise last week. We'll see if it repeats a little bit later this morning. Under surveillance this morning, jumping from data point to data point.
We're close to learning that the next move the Fed will make will be a cut, not a hike, unless it's in years down the road. But, you know, we've had 3 low 0.4 CPI monthly prints, followed by a 0.3. You wouldn't want to over-interpret any of this. They'll need more information. The market is going to be just waiting for the next data point before it does anything else.
Here's the latest this morning. Bond yields falling to their lowest level since April following cooling inflation data yesterday. Investors bringing forward rate cut expectations, fully pricing in 2 cuts this year. Mike Collins of PGIM Fixed Income writing this. Powell is a chair that wants to cut. He will easily do 1, and if data allows it, he will try to do 2. We think this is going to be a very modest reduction. Mike, a good friend of ours in this program, joins us now for more. Mike Collins, let's start with yesterday and talk about what that data means going forward from here.
Yeah, Jonathan, good morning. Thanks for having me again. Yeah, I think we're just moving in the direction we've been expecting, right, which is slight moderation in growth down toward 2%, maybe a little bit below 2% this year, and a continued moderation in inflation. I mean, if you strip out, we're back to stripping out shelter again, right, because that continues to be sticky, running, you know, closer to 6% than 2 or 3. If you strip that out, both headline and core CPI year over year now are back in the low to mid 2s. So we're moving in the right direction. That's our expectation, that the shelter component will probably get cut in half as the year goes on, from close to 6 to closer to 3. So I think it's pretty good news on all front. The question is, as you heard from Williams this morning, you know, why does the Fed need to do anything? I mean, we're in the 0 to 2 cut camp now, as you just indicated. And I don't know. I mean, I think 0 is probably the highest probability of a 0, 1, or 2 if you had to really push me on it. The Fed's MO historically has been sit on your hands, don't do anything until you're really forced to move, until the data really points hard in one direction or the other, and it is not doing that.
And Mike, I want to push you on it. I've got a quote in front of me from you at the start of April. You said this: the economy continues to be solid, inflation continues to be sticky and well above their target, the labour market is still rock solid, financial conditions are the easiest they've been since the Fed started hiking. Why would you cut interest rates with that backdrop? Mike, is that quote still your quote right now? Would you say exactly the same thing?
Absolutely. Now Powell is a dove, right? He is a labor market economist, kind of trained under Yellen. That's his MO. He's very sensitive to getting pushed from the left about the job market. If things change, and things can change rapidly, as we all know, Jonathan, if things change and the labor market really starts to weaken over the course of the year, then sure. A cut or two are definitely in the cards. But right now, the way the data is pointing, I would certainly still stick to that statement that their MO is to do nothing until they're forced to. And again, with the election looming, they start running out of dates, as we all know. So that's definitely part of the calculus.
Mike, we've been playing around with what this means for riskier assets, and a lot of people have had conflicting views about how much it actually matters, since we're seeing a stickiness and a lack of potential rate cuts this year because of positive economic trends. From your vantage point, does this push you further into risk assets and credit, or maybe make you a little concerned, hold back?
Yeah, we're continuing to be pretty defensive in credit. We're continuing to cut back. In fact, our recent trades have really been to continue to reduce exposure to corporate credit and increase exposure to things like, believe it or not, old-fashioned government-guaranteed agency mortgage-backed securities, where they have been a big laggard, not only this year, but over years now, relative to corporate credit. And they actually have some technical and valuation dynamics that actually look pretty appealing, right? If interest rates fall, if you get a weakening in the economy, which again isn't our base case, but mortgages would actually outperform corporate credit in my mind in that scenario. So again, that's an up in quality trade. That's a up in liquidity trade. That's a more defensive trade. And that's generally been our direction of travel.
It raises this interesting point about whether the biggest risk is not a reacceleration of inflation anymore, whether we've basically taken that off the table. And now people are just looking for the timing of when things slow more materially, which is the reason why people are getting bullish on duration. Is that essentially your baseline presumption?
Yes. I think the upside risk, we're there. We've had it. We've had the big boom in nominal GDP. We've had the overshoot in real growth. We've had the overshoot in inflation and nominal growth. We've had the overshoot in interest rates, Lisa. And I think, when the markets just a few weeks ago were pricing in a permanent funds rate of around 4% as the low terminal rate for the next 10 years, I look at that as an overshoot, and that rates were 50 to 100 basis points too high. And then look what just happened. They rallied 40 basis points really fast, right? So now maybe they're still 0.5%, higher than what I would say is fair value, which is probably more in the mid to high threes, let's say, on a 10-year treasury, than in the low to mid fours. So yeah, we're still advising our clients that, you get 4-handle yields across the curve on long-term rates, 4 to 4.5, and anything above 4.5 is the buy zone for adding duration to their portfolios.
Which really goes to this question that we were asking earlier when we were peaking out in rates, about how much these other concerns about the deficit, about tariffs, about a structurally more inflationary environment would really be problematic for longer-term bonds. I have to say, it's sort of a gut check for me, because I hear things like Ray Dalio talking about civil war and the possibility of the U.S. debt completely undermining the value of the dollar. David Solomon with Jonathan Farrell earlier this week talking about how concerned he is about the deficit. Is this all just lip service to basically cover any potential risk that they have, but that everyone just sees this as continuing to be the same old story that isn't going to come to the markets for?
I think of what a lot of people in the U.S., right? We're a very kind of nationalistic, U.S. centrist view here in the U.S., and it is a global bond market, and our clients are big pools of money all over the world. And if you look at, the fiscal situations elsewhere, they're at least as bad as ours. The supply is brutal everywhere. Europe's actually maybe a little bit of a shining star because they actually do have fiscal rules, even though they let them slip. But our rates, Lisa, our rates are 200 basis points higher than China, 200 basis points higher than German and European yields. 300 basis points, 350 basis points higher than Japanese yields. I mean, these investors control giant, sometimes trillion-dollar pools of capital, and a lot of them, especially, pensions, insurance, and sovereign wealth funds and central banks, they buy fixed income, right? And we are the world's bond market. And I think a lot of people in the U.S. forget that. The dollar is still, one of the strongest currencies. And I think it's, when push comes to shove, global investors will look to the U.S. bond market for safety, and I think that will continue to hold true.
Well, Mike, let's focus on that. Let's just get into it just a little bit more. The buyers are still showing up. Have you noticed any change in the background of the buyers over the last 12 months? Is it becoming more domestic?
A little bit on the margin, Jonathan, but we're also seeing more and more interest now, just recently, from non-U.S. investors into the U.S. bond market, right? And remember, it's not just our treasury yields and our treasury auctions, because a lot of these folks aren't buying just treasuries, right? Yeah, in the auctions, it's a big deal. You need a marginal buyer to step in. But we have, the world's biggest, most liquid, diversified, regulated, attractive credit markets, which add a lot of yield and spread on top of that. And that's where you really see the demand. And that's one reason, to your point, Lisa, why credit spreads continue to be pretty tight. I mean, you have a lot of supply of treasuries, not a lot of net supply of private sector debt, meaning corporate debt, structured debt, mortgage debt, et cetera. So that could keep those spreads relatively tight. But, on the auction size, yeah, I mean, they're gigantic auctions, and you think at some point there's going to be a failed auction, and we always worry about that, Jonathan, but wow, we haven't seen it yet, and there's no empirical evidence that supply of treasuries in and of itself drives the level of interest rates. That is driven by growth, by inflation, and by the ultimate path of the funds rate. That's been the case in my nearly 40-year career, and it'll probably be the case for a long time.
If it changes, you're on the list of names we'll call first, okay? Michael Collins at PGIM. Mike, appreciate it. Thank you, sir. Tons of supply, both on treasury and in credit, and the demand stepped up. The buyers have been there.
I love that. He was kind of bearish on bonds, not on credit, on particularly lower risk credit, but he did point out that fundamentals are good and technicals are fantastic, which is the reason why you've seen the supportive aspect to the credit spreads. We're not seeing what people warned about. And we've seen that consistently. We're not seeing the rise in defaults, the sudden rejiggering, survive until 25. They've already survived, and they're going to be fine until 2026. We're not seeing wholesale international buyers step away from the treasury market. That's the reason why I think a lot of these concerns are still on the margins.
Bramo, on the edge of constructive. You heard what Mike Collins said, the 0 to 2 for rate cuts this year, with his bias sort of leaning towards 0 and not to 2.
Which is maybe the reason why he isn't getting into some of the riskier segments. But still, this idea that this is an economy that shows it can keep chugging along at these rates. And I keep going back to that. Has every asset class really reset to that idea? Have we really understood the idea of 5% being something that's just fine?
And embrace the old normal all over again. Third hour of Bloomberg Surveillance up next. Coming up, Matt Miskin of John Hancock, Michelle Meyer of MasterCard, Colin Martin of Charles Schwab, and the JP Morgan CEO, Jamin Dimon, sitting down with the brilliant Francine Lacquer. That's going to happen in the next 30 minutes or so. Look out for that. From New York City, this is Bloomberg.
Just looking at your portfolio of businesses, it is about resilience. It's about pressure. It's about women. So how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
I don't think that we're heading into a higher for longer environment. I think we're heading into a normal for longer environment.
I think where we are now is essentially the new equilibrium. I don't think we're getting back to 2%.
The higher for longer is going to stay there.
Above all, the Fed understands that reestablishing price stability is key. They're not giving up the 2% inflation target.
The economy is doing fine, and I think inflation is on its way to 2% by the end of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now. Live from New York City, there are many ways to get a read on the U.S. economy. Here's three. You could ask the CEO of the biggest bank in America, Jamie Dimon of JP Morgan. Francine Lacqua is going to do just that in about 10 minutes' time. Don't miss that conversation. You could look for the data, 8:30 Eastern time. Jobless claims, the estimate, 220. Or you could look to a large retailer, Walmart, in the pre-market, positive by more than 5%, Lisa, after a beat on the top and bottom line.
There is a cohesive thread coming together, and it isn't clean, and it isn't neat, and it isn't dramatic, which is what the market usually looks for. It is a slow softening, and that I think is clear with Walmart's extreme beat on the heels of higher income customers looking to get discounts in a still inflationary environment.
Bloomberg Intelligence, though, coming out after this report, and they're writing basically this appeal that Walmart has, even for the higher end, wealthy end of the consumer coming in, wanting that discount because inflation is biting. How long will that last, at least for that company specifically? But what it does tell us, at least in some of this hard data from Walmart, is that consumer sentiment, that's starting to resonate now. People are concerned about inflation.
I keep going back to the thing we've asked repeatedly on this program, a welcome cooling or an unwelcome deterioration. And what is the distinction at the moment between the two?
A welcome cooling is something that keeps inflation in check while not necessarily causing jobless claims to rise that much, which is the reason why 830 is going to be really important. An unwelcome cooling is something that happens and it is normal, which is usually, it is not a clean sort of steady trajectory, a linear kind of progression. It usually comes suddenly, and there's a jump up in unemployment. That's what some people are fearing, including Citigroup's Andrew Hollenhorst.
Jobless claims data, 8:30 Eastern Time. Check out the scores in financial markets, all-time highs at the close on Wednesday on the S&P 500 and the NASDAQ 100 for the first time since March. We had some weight to it, just a little bit. We're up by 0.05% on the S&P. In the bond market, yields unchanged, 4.33. Coming up this hour, Matt Miskin of John Hancock Investments as the S&P hits a new record high. JP Morgan CEO Jamie Dimon live from Paris with Francine Lacroix, and Michelle Ma of the MasterCard Economics Institute reacting to jobless claims data. We begin with the big issue. Good news is good news. A caller CPI print sending stocks above 5,300 for the first time ever. But John Hancock's Matt Miskin saying this: in terms of markets, we are still firmly in the bad news is good news regime. This can't last forever, as weaker economic growth likely means lower revenues, more defaults, and eventually plays into a weaker jobs market. Matt joins us now for more. Matt, just walk me through the regime you think we're in.
Yeah, we still think we're in this bad news, good news regime, and it's one that is challenging for asset allocators because treasury bonds are acting like small cap crypto stocks. I did not see this coming. This is something relatively new to this cycle. You know, I'm looking over at the CFA books and the Intelligent Investor and other finance books, and I'm like, where were you on that? But this is a challenging market and one that we think is going to be a bit counterintuitive. We think it's a phase. We actually like the treasury part, the higher quality bond part of the market in that rally that we're seeing than the junk rally. We would trim into strength of some of this lower quality market. Right now, the markets in general are sunning themselves on soft landing island. And we just think this is a great time to prune some risk.
So, Matt, you don't want to get out the umbrella, take a rest, and take in the sun? No?
Have a cocktail, maybe. No, we don't, John. You know, it's something that, you know, we think it's a bit of a welcome gift. And right now, the bar is lower for Q1, nearly for all these economic data points. So the CPI report, for example, inflation, this time last year was relatively high. So the year-over-year comps, what you're getting is you're rolling on some lower data, but the last year data was actually much higher. From here on out, inflation this time last year fell meaningfully. If you look at the month-over-month data. So now the bar is going to be harder to beat. Similarly with earnings growth right now, the bar in Q1 was lower. The bar goes up from here. The estimates for the street are about 9% in Q2, and from there it goes all the way to double-digit earnings growth by the end of the year, and 13% earnings growth for next year. We're bumping on about 21 times on the forward PE on the S&P. That's about as good as it gets being priced in. So right now we're looking for income as a return driver, alternatives. The dollar we think actually could be a great diversifier for portfolios here, and thinking about defense more broadly.
So bonds have rallied, stocks have rallied. You alluded to maybe liking the bond piece of that rally. Let's just sit on stocks. How would you fade that? What would you trim? Can you be more specific? Are we trimming what's happened in small caps the last 24 hours? Are we trimming what's happened with big tech over the last 5 days? Trimming the all-time high in the S&P, the NASDAQ 100? Where would you trim?
Yeah, we would start with the Russell 2000. And the Russell 2000 right now, we hear a lot of fundamental thesis around small caps being cheap. And actually, we totally agree with that. But nearly 40% of the Russell 2000 companies don't make money. They're not profitable. In addition, what's been driving small caps as of late are crypto miners and meme stocks. So if you have a fundamental thesis on the Russell 2000 that it's cheap or there's some sort of other macro thesis, what is actually driving it is a lot of speculation. And if you want to go long speculation, actually, that's a great way to do it. But that's actually the place we would trim first. Internationally, economies have been improving. We've been warming up to that, Europe in particular. But we think this China trade might also be starting to get stretched here, overbought. A lot of headlines. Every day you get a new headline out of China. But for us, the fundamentals still aren't strong enough to support it.
So, Matt, you're not in the camp of buying necessarily European bonds to try to diversify away from the U.S. and hinge yourself more closely to the easing cycle. That's not something that you're kind of leaning into?
It's somewhere looking at, and duration is a tailwind there. I get it. It's been working. So congrats to those that grabbed that. But what we're seeing is just a massive yield disadvantage. We're thinking about bonds more as a longer term investment for clients. And we're getting, there was a point where we're up almost 6% yields on just a kind of mild credit bias in portfolios. Municipal bonds we like. But what we're seeing is the yield advantage is just so amazing in the United States. I know, Lisa, I'm really getting excited about the yield here.
You are. It's absolutely. It's inspiring. It's infectious, Matt, and I love it. Keep going. One thing that you say, as you sort of paint the picture that we're in right now, is that you say that we're coming off a mini cycle of its own that really started in November with the pivot from Fed Chair Powell. How much is that actually the way to look at this? And I think that it's a really good point that essentially the promise of rate cuts fueled risk assets enough to then fuel economic growth and inflation to keep things chugging along for longer than people expected. Is that how you view things?
Exactly, yeah. And it's just all about context. And you rewind 6 months ago, and the Fed was talking about rate cuts. So what did the bond market do? They said, sure. And if, in fact, we're gonna double that. We're gonna up the ante, if you will. And so they said 6 cuts were gonna be priced in. And so pricing in 6 cuts, I mean, can you imagine if the Fed had said at that point, we're gonna cut 6 times? I mean, of course we're gonna get a reacceleration of growth and inflation. So that was 6 months ago, and now the Fed is having to deal with that. They're going to have to, they're trying to peel that back. But that's what a mini cycle looked like. You saw a bottom in economic activity in November, right around then, bottom in inflation pressures, and then that's reaccelerated. And now as rates have come up, we look at housing, for example. Housing is such a critical part of this whole economic equation, and housing, the NAHB housing price or housing builder sentiment index that actually came out yesterday ticked down for the first time in 6 months. And if housing's starting to slow, that's a good indicator that this cycle, this mini cycle, might be slowing. And then again, we go back to those small caps, those lower profitable companies. They're not going to like if this mini cycle's slowing. Right now, they're loving the risk on mood, but we think the fundamentals are going to deteriorate underneath the hood.
Matt, appreciate the update. Matt Miskin there of John Hancock. Looking ahead to more economic data in about 21 minutes' time. Jobless claims in America. Up next on this program, the conversation of the morning. Do not miss this one. The JP Morgan Chase CEO, Jamie Dimon, live from Paris with Francine Lacroix. That conversation just around the corner.
Access the financial world on demand. Hear from leading economists.
My general advice is continue to seek out companies or people that are maybe 1 stage or 2 stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too.
What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I mean, if you don't pay, that much attention to it, it means you're not worried about anything.
No, I'm worried. I just said stocks are very high, and I think the chance of inflation staying high or rates going up are higher than other people think. So I think the chance, my view is whatever the world is pricing it for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
In the U.S. or globally?
Well, I'd say in the U.S., but also that could affect globally, yeah.
And so what does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
Where does that happy talk come from?
Low rates, central banks are going to reduce rates. Maybe the geopolitical things disseminate, don't cause problems, and so the future isn't predictable like that. So I'm a student of history. I've watched all the inflection points. If you go back, and my dad was a stockbroker, I go back to the booming markets of 72 and the collapse of 74. The healthy markets of 80, the collapse of 82. The 87 market crash, the 1990 real estate crash, and almost all of them were not predicted the year before. So I look at these factors that drive these things. They're not always known. As a company, we prepare for all of this. We can serve all our clients regardless.
But what do you see as the main stress right now? Because if it's geopolitics, we talk about it. It's just not really priced in. Is it distress? Is it something actually going under that you worry about, or just multiple factors coming in at the same time?
No, I think geopolitics could create the main stress that we're worried about in terms of oil and gas prices, trade alliances. But I think the surprise would be higher rates because inflation didn't go down. That inflation's been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise. If you had higher rates and God forbid stagflation, you'll see stress in real estate and leveraged companies and some private credit and things like that.
So is unpredictability the new normal?
I think it's been the norm since my whole life.
Has it?
Yes.
Not worse now?
No.
What happens between China and the U.S., and what does that mean for your appetite of being China?
Yeah, so the geopolitical situation is very tense because of Ukraine and Russia, Iran, the terrorist activities in Israel, North Korea, nuclear blackmail. We've never had nuclear blackmail before, and this is, of course, affecting our relationship with China. And, it's going to be hard to have a great relationship with China as the Ukraine war is on. We're kind of on different sides of that. And put Taiwan aside. Having said that, I think it's the right thing for America to fully and deeply engage with China, competitively. Every nation is going to do what's in their own interest for national security. So should America. We should define that fairly and properly. If there's unfair trade, negotiate that or do whatever you need to do. But the engagement is the right thing to do. China is not a natural enemy of the United States. They have a lot of their own problems. So, to me, we could work together as best we can. And then we have common interests: climate, anti-nuclear proliferation, anti-terrorism.
But what does it mean for a bank working in China, actually, given all of this volatility?
They're cautious. I mean, China, if you look at China from a risk-reward basis, it used to be very good. It's not so good anymore because all these things can go wrong. Remember, we bank, I've got the number, but 1,500 multinationals in China. They're not leaving China, so we're going to serve our clients there. We're just much more cognizant that the risk is higher. And I put Hong Kong in that bucket too. We kind of look at China, Hong Kong as one at this point from a risk standpoint.
What does the Trump administration mean for the U.S. economy?
I don't know.
Why? Because it's unpredictable, or because we're too soon to actually trying to figure out the policies that he would put in place?
So if you look at history, who was elected president may not necessarily affect the next year. That's kind of like we're a big tanker and that's going to happen. I think the much more important thing is what we do in the geopolitical situation. I've always been quite clear that American leadership is provided to keep the world free and safe for democracy. And that means economic alliances, which includes trade, by the way. I think we should spend more time in trade. It means NATO. It means that Russia should not win in Ukraine, because if they do, I think it can tear asunder this Western world.
I know you've ruled out being Treasury Secretary. Yeah. Why? What would it take to get you into politics?
I don't think I'm suited for politics. I love my job, and so I'm not sure I want to do something like that. And I can hopefully.
But even if you got the call, would it be hard to say no?
I don't know. Probably yes. I love my job, and I have no interest in leaving or doing anything else. So.
We're in France at a global markets conference. What are you expecting from Basel III? What will Jay Powell put in place in the new rule book?
I should mention, by the way, because President Macron has done an outstanding job here. Pro-business, got us to move our trading floors here. He wants to grow his economy. There's much more innovation. We had a thing last night about innovation. So, look, Basel III, we've been quite clear. We thought it was excessive, not well thought through. I would love to know what the end game is. What are they trying to accomplish with private credit? What are they trying to accomplish with, like even the other day, 80% of mortgages left the system, and now the government is talking about having a bailout system for mortgage companies because they're no longer in a bank that has the ability to provide liquidity in tough markets. That would be the same thing in market making. So they're looking at it. I trust Jay Powell to look at and analyze what they need to do, how they need to do it. The other thing, which I'm not sure Europeans know, I have no idea. And it may end up in a lawsuit or something like that, but the amazing thing to me is that America ended up, the end game, 30% more capital than a European bank in America. And I just, why are we arguing about international standards and then we simply don't do them? And also, I think the regulator should answer the question, what do you want? How do you want the system to work? Do you want it to private credit or public credit? Do you want mortgages out of the banks? Just dictate it. If that's the goal, just dictate it. If you don't want leverage lending in the bank, just dictate it. And I think, we are guardians of the financial system. We bank 100 countries, and we're on the ground in 60 countries. We do great work for cities, schools, states, hospitals, solar, wind, climate, middle market companies. Is that what they don't want or they do want? They want to make it more expensive.
But they know, or are they still trying to figure it out?
I think they've got to figure it out. I don't think it's quite clear from any analysis they did. You guys should read it and write about it. There was no detailed analysis about cost benefit, what they're trying to accomplish, what the outcome will be.
That's why we're asking you, Jamie. Talk to me about France. So you're positive on the President Emmanuel Macron. I also know that you were at the Choose France event on Monday. If he relaxed labor laws, would you hire more in this country?
He did relax labor laws.
But if he relaxed them more?
Possibly. We now have 1,000 people here. We have large trading floors here. We trade. I've got the number 5 or 6 or 7, $800 million a day. When you have 1,000 people, you tend to hire more technology, more, and that's been true for us since I've been at J.P. Morgan. Once you have a very competent group of people and you have hiring and capability and friends, you tend to do more things there. So my view is we will be doing more things here. And it was the tax law they put in place, the regulations they put in place, the labor flexibility they put in place. Those things do make a difference. And very importantly, they don't just lift up J.P. Morgan here. We pay a lot of taxes here, which help lift up all citizens. I don't think President Macron did that for J.P. Morgan. He did it because he knows his country needs to grow, bring in innovation, and that's how you build a better country.
So the chief executive of the largest wealth fund in the world says that actually America's doing much better because Americans are less lazy or work harder than the Europeans. I mean, is that fair? Is that regulation?
I hate total blanket statements like that. I know a lot of Europeans who work hard, but I think when you see the thing about work hours, I think it is somewhat true. Americans are hardworking. Anywhere you go around, Americans are hardworking, but I see that here too. I don't think, and the innovation people you meet, they're working just as hard as the innovation people in the United States.
So you also, in terms of headcount in the UK, I think it's at the highest that it's ever been, and you're also you're giving money to try and retrain.
Yeah.
You've recently met with possibly the next Prime Minister, because he's so far advanced in the polls. What do you think?
Yeah, look, I like the fact that both the Conservative and the Labour governments are talking about pro-business, simpler regulations, getting more innovation in the country, becoming competitive, and we all need, like we all have too much debt. Growth is the best antidote for everything. And so having a growth strategy is good for a country, and it's good for the lower income people. And this training stuff is maybe the most important, to get training, jobs. That first job is a first rung in a ladder, creates dignity, more household formation. And I think countries have to do more of that, because if they don't, you can have a tough time.
But do you think the UK economy will change under Labour?
I don't know yet, but I was happy with what they were talking about. We had Rachel Reeves come to our conference too, that they're all talking from the playbook. We need growth, simpler regulations, more capital formation, more capital investment, meaning proper taxation, because that's the way to help our whole country and all our citizens. So that is what we should all be doing.
Jamie Dimon, we talk around, India all the time. Is this a decade for India, and does it somehow counterbalance China for, world growth?
Yeah, look, I think India has done a very good job. And, when you look at India, yes, it should have a very bright future. I'm not saying as a counter to China, but a very bright future. And I think we should all be reaching out to India. That, they have to stay non-aligned because they're kind of where they are in the world between Russia and China. But, they're a democracy. They're a natural friend of America and the Western world, and we should all be helping them. And they've made a lot of changes there. Infrastructure, transfer payments, 700 million people bank accounts that are going to be very good for that country.
So what does that mean for J.P. Morgan?
Well, we're not in the retail business there, but
will you be in the future?
We have 60,000 employees there. We got big campuses, high technology, and we're expanding our trading, our research, our investment banking. Yeah, we're there in a big time. Yeah.
Can you talk to me a little bit about J.P. Morgan and how, you've had a number of high-profile departures. How does that change, actually, the way you focus your business and how you run things going forward?
Not at all.
Nothing? Zero? If you were to buy anything, what would you buy?
Oh, that's different. Look, we can't buy banks. You do know that. So,
Well, you could buy your European bank. Could you?
I wouldn't even try. I think the American regulators would hate it. I think the regulators here would hate it. Even if they said, go ahead and do it, I'd probably be in courts and things for a year and a half. Huge distraction to my own company. I'd rather just say we want to add clients in this country and clients in that country. We'll add bankers and technology and branches. It's just a better way for us to grow.
Okay, but if you could buy anything, not a bank.
I can't tell you.
But you're thinking of something?
Yeah, we always look at stuff, yeah.
What region?
But no, we're not looking at any major acquisitions or anything like that.
Technology?
Right now, if you look at what we're doing, we're adding literally, we have Investor Day next week. We're adding retail and wholesale branches. We're adding them in the United States. We're in almost all the major 100 cities there now. We're adding commercial banking all over Europe and Asia. We're adding technology around payments and even a blockchain called Onyx to move data and maybe move money one day. We're constantly investing. We have 2,000 people in AI and machine learning, 400 use cases on the way to probably 800.
I know. So if I speak to you in 5 years, how much bigger and how much different
You'll probably be speaking to a fake diamond who's just answering questions.
What, an avatar?
An avatar, yeah.
Do you think about technology a lot?
Yes, all the time. Every meeting we have, this has been true my whole life, when we have any management meeting, your technology agenda is on the table. That includes AI, cloud, just more analytics. What are you doing to do things better, faster, quicker for clients? Digital, a huge amount of digital services, integrating them better, automating them better.
But that would change. That will change, I guess, the heart of banking. does that mean that you'll see more winners and losers because of the technological advancements?
So technology has always changed. The heart of banking, moving money, holding money, advising money, raising, that won't change. And you have to do that according to rules, laws, regulations by country. What'll change is how you deliver it. So like right now, you go on your phone and you can move money and buy stocks. That wasn't true 20 years ago. So yes, everything you do will change because of technology, but you'll still have to move money, budget, raise money, make investments, etc. So the core won't change.
But will it change?
And regulations may change that too, obviously. So
in the U.S., so again, would a Trump presidency be more favorable to banks when it comes to regulation?
I don't know. I mean, I am unhappy with the amount of rules and regulations coming out today. I don't know what a second administration of either one would do. I'm hopeful that they focus on growth, which is good for the citizens, which is good for the country. And I would help anyone I can to do that for my country. I'm quite patriotic about that. And I do think you need
What, in terms of serving?
I think you need helping.
Oh, helping as the bank.
Yeah,
okay.
exactly.
It's good to get that clear.
Exactly.
Okay, Jamie Dimon, thank you so much for joining us. That was, of course, the J.P. Morgan Chief Executive Officer. With that, I'm going to send it back to you, New York.
Hey, Francine, thank you. Just a fantastic 15 minutes sitting down with the CEO of Jamie Dimon, the brilliant Francine Lacqua, breaking down the markets there and everything else. I think what you heard there, it's really important to point out, that was not an economist giving you a base case, a strategist giving you a point target for year end. It was a chief executive talking about a very wide range of outcomes that he needs to manage wherever they fall.
What I find interesting is his range of outcomes still has skewed also to the idea of yields going higher, of inflation remaining stickier. Again, not a base case. He's not calling for yields to go to 6% or 7% or 8%. But how do businesses hedge against that possibility at a time where they have to be prepared for risks that really are maybe a little bit more unpredictable right now?
If you're a bank executive, these are things that you'd be worrying about. MH, also a lot in there about foreign policy and international risk too.
Yeah, interesting what he had to say about the U.S. and China can work together. That's the complete opposite of what we've been seeing and what potentially we will see, whether or not it's Trump or Biden next year. I mean, just this morning, the Wall Street Journal coming out from the Homeland Security Department, how they're blacklisting a number of Chinese companies due to what they're calling forced labor and Uyghurs. We've continuously see time and time again, whether it's export controls, tariffs, sanctions, there's a lot of daylight between this relationship, but he says they're not necessarily natural enemies.
If you're just joining us and you missed that conversation, you want to go back over it, it will be on the Bloomberg terminal and at Bloomberg.com. Francine Lacqua sitting down with the JP Morgan CEO, Jamie Dimon. In about 50 seconds' time, we'll get jobless claims. So let's work through the financial markets and bring you the economic data. Equity futures going into it, just about positive by 0.1% on the S&P after closing at all-time highs in yesterday's session. On the Nasdaq 100, on a 5-day winning streak through Wednesday, this morning up by 0.15%. If we turn to the bond market, we've talked about the levels we've been to over the last month, through 5% at the front end of the curve on a 2-year, all the way back down to the 470s, 474 this morning, and up about 2 basis points on a 10-year. Lisa, life in the 470s was only a few weeks ago. We're back down to the 430s.
With people really looking at this idea that, yes, we got the lowest inflation rate of the year, we can finally see disinflation back on track. We hear from a host of Fed speakers. Is that actually the case?
Let's get to the economic data. You've had the Fed commentary. Jobless claims in America last week came in at 231. We got the wrong kind of upside surprise. Right here, right now, back down to about 222. We were looking for 220. That was the estimate. We came in at 222, down from the previous week of 231. If we get a revision, I'll bring it to you. The financial market reaction to that, equity futures positive still by 0.2% on the S&P, on the Nasdaq by 0.2%. Also, in the bond market, if you can switch at the board just briefly and look at the front end of the curve, the 2-year just about unchanged, 473. Lisa, if you were concerned about maybe a continued breakout in jobless claims, you don't see it this morning, this week.
It doesn't seem like this is a labor market that's seeing massive fissures. That said, Constance Hunter made a really good point where she was saying we're seeing the end of labor hoarding. There seems to be a change in the dynamic to something maybe more normal. It isn't necessarily things wholesale shifting, but there is this creep higher in the sense that, remember when jobless claims always came in below expectations? That's shifting, right? I mean, it was expected to be lower and it came in, albeit 2,000, but a little bit higher.
We've had some Fed fakes, though, where you sort of break out above 200 and then come all the way back down to 200K again. This is what we're trying to work out about yesterday's inflation data as well. Is that the head fake or the real deal, or was Q1 the head fake or the real deal? What are we going back to this summer? Where will we be, not in 2 months, 3 months, 4 months, where will we be next week, the week after that? Because this narrative keeps changing from day to day.
And part of the problem is, and I keep going back to this, it's so confusing because there's so many different populations. There are different labor markets that are kind of overlapping. There are different consumers. We were talking about that K-shaped recovery, and it's getting that much more difficult for the lower income tier. We're seeing even the upper income tier with Walmart go down the income spectrum. At what point is there consistency in the reads across some of the data that we can get a narrative that actually sticks?
A ton of economic data in front of me right now, but the highlight, jobless claims 222, the estimate 220, the previous week a revised 232. With us around the table, Michelle Ma of the MasterCard Economics Institute and Colin Martin of Charles Schwab. Michelle, first to you. What do you make of that economic data? And let's sort of fold it into yesterday as well. What do we take away this week?
Well, I think it shows that the economy is evolving as it should be as this business cycle matures. So initial jobless claims still very, very low. Little to no evidence of challenges in the labor market. If you look at the 6-month moving average for job creation, we're running at about 250,000 jobs per month. You have more labor force engagement. You certainly have the support from the labor market. On the inflation side, I do think you're seeing potentially some moderation, certainly in the goods side, less on the services side. But it's part of what you would be expecting to see as this, again, this cycle evolves, where the goods economy kind of overinflated and now it's correcting. The services economy is still seeing a lot of momentum and strength.
One piece of the data puzzle we didn't touch on just then, retail sales. How much weight would you put on that weak print yesterday?
I don't think it's that important on a month-to-month basis. It follows off of very strong retail sales numbers earlier in the quarter in Q1. So if you look at the trend for consumer spending to start this year, it's been strong. It was a critical part to the upside beat to Q1 GDP. If you look at real consumer spending tracking for Q2 from the Atlanta Fed measure, we're running at about 2.5% on an annualized basis in real terms. That's still a consumer who's out there actively participating in the economy.
Colin, do you agree that this is sort of a shifting economy to where it should be, not necessarily falling off a cliff?
Yeah, I think so. When we look at the data, we see things slowing, but it's cooling but not cool. And we're not expecting things to fall off a cliff right now. If we look at the inflation front, I think it's a step in the right direction. But if we still want to look at the actual numbers, and CPI, obviously we're going to focus more on PCE, but with CPI, 3.6%, 3.5% area year over year, that's still a little too high. And 0.3%. It was an improvement from the first quarter, but that's still elevated if you look at it from an annualized basis.
We were talking earlier about how no one shifted their views after yesterday's data, and it seems like no one's shifting their views in general, and everyone's just sort of entrenched with whether we've nailed this soft landing or whether we're heading toward Armageddon or whatever you want to say. I'm just wondering, it seems like the market's weighing in, and it's just basically celebrating the victory of the soft landing. Colin, would you weigh in and basically say, yeah, let's celebrate?
We're not celebrating just yet. We try not to get too tied up with every single release, because we do have more of a long-term view when we're providing our guidance. It's a step in the right direction. We have not changed our views. Coming into the year, we expected 3 cuts. We shifted it to 1 to 2. Yesterday's report, again, good news, but that's not getting us back to the 3-cut area right now. So we're still comfortable with 1 to 2 right now.
What's the date for that first one? July, September? What are you looking at?
I'd say September. I saw a comment about July, and that just seems too early right now, given what we saw in the first quarter.
We get another CPI print in the middle of June, same day as the June meeting, another one in July. Back end of July, you get a Fed meeting. Is July still too soon?
I think it's in play. I think at this point, the Fed has made it very clear they are monitoring the data. They're looking at financial conditions. They want to understand the evolution of the economy. And they're not talking about cutting interest rates because there's a significant problem in the economy. They're talking about normalizing monetary policy. And I do think that's an important distinction when you think about what are the triggers to get them to start shifting the interest rate environment.
Let's run with that word. They're talking about normalizing without talking about what normal might be.
Fair, yes.
Okay, so what is normal going to be in this regime? And why aren't they talking about it?
I think they don't know. They don't know what those star variables are. But it does seem like the commentary is that they're probably higher than they had previously thought, right? That the star variables are likely a bit higher, that we're probably going to be in a higher for longer rate environment, maybe a little bit stickier, higher inflation, a little bit, maybe higher potential growth rates, at least for now. And that's going to influence as well how they think about the timing of the cycle.
You put out data that I thought was fascinating. A record high, 15.9 million Americans traveled internationally in the first quarter. Cruise liners are going bananas. Yes. You have people basically spending, incredible amounts every day on experiences and going, jet skiing and going bungee jumping. And there's this question of, okay, well, how much does a Fed cutting rates now basically give a gift to people who are invested in this market, can really benefit from the upswing and not fight the inflation that's causing people at Walmart to really be selective?
Look, I think when you think about what's happening in the travel economy, it is super meaningful. Those stats that you just referenced in the report we just put out in the Economics Institute of MasterCard is huge. I mean, this is a sector that is seeing extraordinary growth in terms of the number of people who are traveling, the different destinations that they're trying to embrace, the intention that they have in terms of choosing where they're going based off of what they're seeing for currencies, what they're seeing for affordability, for new and interesting places to visit that they haven't been. There's a lot of demand out there to have these types of experiences, and travel is the #1 experience. And the fact that you're seeing this type of growth tells us that the consumer has purchasing power. The consumer is still active, and the labor market is still very much supportive in that regard. So I think for the Fed, they have to look at the big picture. They have to look at total spending, but then try to understand what's happening in terms of the moving parts within that.
So, Colin, if I take a look at, for example, a hotel that cost me $200 2 years ago, and now I'm looking at $400 with what John would say would be fewer services, I'm wondering, how is this not inflationary, given the fact that people are willing to spend, who are in a cohort who have money to spend, even at a time where there's an increasing cohort of people struggling under the weight of inflation?
Well, I think it goes back to the sticky point right there. But if we look at what does the outlook look like going forward, is there going to be a reacceleration right there? Because I think the idea of excess savings, I think we can put that behind us right now. It's not something I really think about too much. I look at the labor market, as we've talked about, still strong but cooling. We're seeing wages still grow. Until we see more of a sharp fall off, we'll probably continue to see spending remain high, but we are seeing some worrying signs out there. I think Michelle probably has more data than I do, but on the consumer credit side of the equation, we are starting to see those delinquencies turn up a little bit. We're seeing more and more credit, although the pace has slowed down a little bit. That's something that we're paying attention to, because if we're using more and more credit in a high rate environment, we think that over time that should slow things down.
Just for the record on the hotels room, what I don't like, and other people agree with me, is when they sort of say they're going green, so they're not going to do the laundry, unless you really want a clean towel, in which case leave it on the bathroom floor. That's what annoys me. Okay. You've spent a significant amount of money to stay in a decent hotel, and then they want to sort of like pressure you into this sort of moral conundrum. Do you have a clean towel?
I'm sorry.
He also doesn't
or
like
do you
hotel
save the
points.
planet?
You have to have
clean towel.
There are 15 towels underneath the sink usually. Do you use every single one of them?
Sometimes I use a lot of towels.
Well, that's an image
Sometimes
that I really
I use a lot of towels. Then you want a clean towel.
Yeah, you want a
You stay in a
consistently
hotel,
once.
2 showers a day. Why not?
Okay.
Paid for it.
Why not 5?
What a conundrum. Clean towels, save the planet. It's tough, right? Michelle, we won't talk about that. Let's talk about the economic data. You don't want to talk about that. Delinquencies. Is that normalizing, or is that something to worry about? What's happening around those kind of themes? People struggling with debt.
So if you look at the New York Fed survey that came out this week, which I think is probably the most comprehensive measure of what's happening in the state of household balance sheets, you have seen continued move up in delinquency rates just above where they were prior to the pandemic. So it's still part of this kind of normalization process. And I think it's partly a function of the fact that interest rates are higher, which is part of what the Fed was intending to do by increasing interest rates in an environment where the economy was very, very hot. The goal was to cool down the economy, prevent inflation from becoming unhinged, make sure that we can continue to see the economy grow closer to trend for a longer period of time. So I think it's part of what's playing out in a high rate environment, as Colin noted it as well.
We were all seduced by this idea because this is the outcome we want. We wanted to be able to get inflation back down to 2% without the pain that Chairman Powell talked about in Jackson Hole in August 2022. It feels like we've got so far without the pain, got to about 3.
Yeah.
Do you think we can get back down to 2 without the pain?
I think we're on path to do that. I also think there's a question of, do we have to be right at 2% for them to feel like they've achieved what needs to be achieved and to feel as though we've reached equilibrium? The Fed and central banks broadly have always talked about this idea of a range around the target. And for a period of time, post-financial crisis, inflation was running significantly below target, which led to this discussion around asymmetry. And now inflation is running a bit above. So as long as there's a belief that long-term inflation expectations are well anchored, which they'd be relying on surveys for, I think that, as long as we're in that range of 2% inflation, I think that is probably quite acceptable.
This is what David Kelly was talking about yesterday, and how maybe the Fed needs to look at what Canada's doing, look for a range of 1% to 3%. What do you make of that? Do you think they should be targeting a range, not be obsessed with that 2% target?
I don't want to get into what their policy will be, but I think I'll piggyback on Michelle's points about what they're probably looking for. They don't need to see 2%. They've told us they want to see it moving down towards 2%. They don't need to wait for a magic number before they start to cut. We think that will probably come soon, but what's important, I want to go back to another point of Michelle's about what is normal. I think in this environment, given that the economy has remained resilient, given that things are going pretty well, when they do start to cut, it's likely not going to be because they need to save the economy or something like that. It's more just bringing it down so real rates don't get too restrictive. But what we're trying to figure out is, well, what is that ultimate landing place? Because that has implications for all parts of the yield curve.
Well, Neil Kashkari talked about that yesterday and said maybe they're not restrictive enough and we should be putting 2 feet on the pedal in terms of the brakes. Do you think that actually they are not restrictive enough and they might just want to hold for even throughout the entire year, not wait till 2025?
It's possible, but I don't necessarily agree with Kashkari's points. He's been saying that for a while. I think he's in the minority. It seems like there's enough officials out there, Powell included, that think it is restrictive. But I think there's a difference between Fed policy and then actual financial conditions. And when we continue to see stocks rise, credit spreads stay low, when you look at it from that point, from a wealth effect, maybe things aren't as tight as some might think.
And here's the psychology portion of the Thursday morning.
Oh, Therapy
Michelle,
Thursday.
Therapy Thursday, as people try to grapple with, am I getting too sanguine on this soft landing? We hear it. There's sort of an angst about being with this consensus and this sort of hopeful feeling. Michelle, do you feel that with your colleagues, that sort of people feel like things are okay, but they feel reluctant to say it because it kind of feels wrong to lean into kind of the consensus and where we're at?
Well, I don't know. I mean, I think for me in the institute, we've been pretty optimistic for a while, feeling pretty comfortable with that.
Well, there you go.
Maybe I'm
Take a victory lap.
But I think that people are careful because this is a very different business cycle, right? It was a business cycle that was spurred by one of the largest external shocks that we've seen in a very long time, which was the pandemic. And so much has transformed in the economy since then that I think people are trying to figure out how much are cyclical changes, how much are structural changes in the economy, where do we ultimately settle, back to this conversation around these trend variables. But I do think that examining the real-time data has very much led us in the belief that it's an economy that still has room to grow, and we feel comfortable with that.
Well, and Colin, from your perspective, you still like duration. You're saying you have an opportunity, keep going, which feels comfortable if you look at history and you think, okay, we're going back down. Do you still have that conviction, and is it ever difficult to just stick with it?
We still have that conviction. We've had it for a while now. We're probably at 12 to 18 months where we've been suggesting that. The good news is, if you're an investor or a Schwab client and you haven't yet, you still have the opportunity. I mean, we're not at the highs of this year, but we still have that conviction because we don't expect yields to rise much further from here. In order to get, say, the 10-year, for example, to get back to that 5% level, we think we need to see really that reacceleration in growth and inflation, and then the expectations for Fed policy to shift from either not just higher for longer or cuts, but actually to a hike. And we just don't see that happening.
What happened to this idea of the industrial policy being inflationary, this idea that tariffs would be inflationary, that people spending their baby boomer money would be inflationary? What happened to all of that seems to have suddenly been forgotten, or not forgotten, but dismissed by, this is a new era, we're good, it's not going to be like that?
Well, things are going well, so maybe it's just kind of the psychology aspect, and if you see your balances going up, and if you can handle that, if you locked in a low mortgage rate, maybe things are looking pretty good. But we're still holding the line that we think over time we're going to see those long and variable lags, and that the longer the Fed holds at these rates, it should slow things down. One thing we are looking at is how this impacts the credit markets, especially where we can see some cracks is maybe in the junk part of the market. Higher for longer should hurt them more because they're more sensitive to high rates.
Michelle?
Well, I think what you raised around how do you think about these bigger issues impacting inflation, I think they are all impacting inflation, right? It's difficult to understand exactly why we're at this stickier inflation environment, right? You do know that, yes, in the pandemic, when it first occurred, supply chains were distorted, you had this big cost push, and goods prices set higher. And they're starting to correct, but if you look at the level of a lot of goods prices, it's still significantly above where it was prior to the pandemic. So is that still the pandemic hangover, or is it some of the factors that you suggested, which are a little bit longer term in nature? So it goes back to this idea of Will we have a bit stickier inflation? Will we have a little bit higher for longer interest rates, as Colin was just talking about?
And this is what Jamie Dimon was talking about with Francine about 20 minutes ago as well. Michelle, thank you. Going to leave it there. Michelle Mather of the MasterCard Economics Institute alongside Colin Martin at Charles Schwab. Colin, thank you to you as well. If you are just joining us, welcome to the program. Moments ago, we had jobless claims in America coming at 222. The estimate was 220. The previous week was a revised 232, so a little bit lower on the week at least. Equity futures still just about positive by 0.1% on the S&P 500. Going into the opening bell about 44 minutes away. If you check out the bond market, yields climbing higher just a little bit, creeping higher by 3 basis points at the front end of the curve. The 2-year just below 476 on a 10-year yield this morning, just about unchanged at 434. And to check in on the euro, the dollar absolutely slammed yesterday against G10, taking some of that back this morning against G10 again. Against the euro, 108.65. We're negative on that currency pair by 0.2%. Colin, Lisa talking about cooling but not cool. And Andrew Hollenhorst of Citi talking about slowing, but I guess not slow. The US economy is finally slowing down with job growth decelerating, consumer spending on goods declining, and looking for that first rate cut, over at Citi at least, to come in July.
What did Matt Miskin say? We're all sunning in the glory of a soft landing sun, and that seems to be where everyone's at. Essentially, just basically threading this needle perfectly as everyone dances on the head of a pin.
A soft landing island, I think he called it.
Soft landing,
soft landing
Thank
island.
You. I knew I was not getting
Just
it totally right. It was much better
for this
than that.
summer.
Yeah.
And Bramo baited me with that hotel point because you know I was going to bite.
I knew.
You know I was going to bite. Okay.
You're welcome.
Let's get you an update on stories elsewhere this morning. I'm not sure the audience feels the same way. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bridgewater founder Ray Dalio told the FT that he's concerned about U.S. markets and the growing geopolitical tension. He said that rising U.S. debt levels could impact the Treasury market and that the risk of another international conflict could reduce foreign demand for Treasuries. The billionaire said that while the best parts of the U.S. are still the best parts for the world and for capitalism and innovation, that investors should look to move some of their money elsewhere. Senator Bob Menendez is blaming his wife Nadine for gold bars seized in their home by the FBI. The New Jersey politician is currently on trial for corruption. Prosecutors allege that Menendez is at the center of a multifaceted scheme that involves bribery and acting as a foreign agent. The senator's defense attorney pushed back on claims that he took those gold bars and cash and a luxury car from 2 businessmen in exchange for favors, instead telling jurors that the gold in particular was given to his wife without the senator's knowledge. And Netflix will be airing 2 NFL games on Christmas Day. It's, again, the streaming giant's push into sports. The company signed a 3-year deal with the league, which will see at least 1 Christmas game on Netflix in 2025 and 2026. But it also just adds 1 more platform you need to watch the NFL games. They are set to stream this season across Netflix, ESPN+, Peacock, Amazon Prime, and YouTube's Sunday Ticket. And that's your Bloomberg Brief. John.
Messy. Danny, thank you. We've got so many things to say about this, so much to say, but here's another point. If you don't know where to find the sport, I don't think it's good for the sport. I see this in other sports as well. I've settled down a little bit with Premier League football in this country at the moment, but when it went to Peacock, which games are on Peacock, which games aren't on Peacock, when you have to sit there on a Saturday or a Sunday trying to find the game, that's not good for the sport.
And if you're a kid who gets all of your television off of YouTube and you can't find it there, are you going to be the fan for those teams?
Exactly.
Seriously.
I think it's a real problem. It's not good for the sport at all, especially at a time when NFL is doing so well at the moment in this country.
Capitalize on it.
There you go.
Bring Taylor in.
Get Taylor in and do a special on Netflix. Is that what you'd like? Okay. All right. That annoys a lot of people, you know.
I do.
It's like 2 camps that don't care and other people who really do care.
Yeah, well,
very
Ray Dalio,
fired up about it.
Ray Dalio is a Swiftie, so, you know.
Didn't know that.
Yeah.
Mohammed Al-Arian too. We mentioned
He even
Mohammed.
thinks she can run for president, Ray Dalio.
Is that what Ray thinks?
Yeah.
Why? Does he actually think that?
She can bring a lot of people together from different walks of life.
Yeah, he said he'd be into it if she had the right people around her.
What does it say about the state of politics in this country that we're talking about pop stars uniting the country and running for office?
Exactly what it should say about 2024.
And not good. Up next on this program, setting you up for the day ahead. You're watching Bloomberg Surveillance.
news and tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Barry Knapp, thank you for the support. You and I share all the same problems, airports, where to watch football, and I even empathise with your hotel issues as well. Thank you, Barry. And for the other people that reached out in the last 10 minutes, all three of you, I appreciate it. Equities right now just about unchanged on the S&P 500, yields higher by a single basis point on a 10-year, 434.97. On our radar, about 40 minutes away from the opening bell, the data-dependent Fed.
We're not celebrating just yet. We try not to get too tied up with every single release because we do have more of a long-term view when we're providing our guidance. It's a step in the right direction. We have not changed our views. Yesterday's report, again, good news, but that's not getting us back to the 3-cut area right now. So we're still comfortable with 1 to 2 right now.
So here's the trading diary for the next 24 hours or so. Chipmaker Applied Materials reporting earnings after the closing bell. The Fed speak lineup is absolutely stacked. You'll hear from Barr, Barkin, Harker, Mester, and Bostic ahead of Waller to round out the week going into the weekend. And Boeing holding its annual shareholder meeting at 11 a.m. tomorrow. If the regulator can't regulate Boeing, can the shareholder? We'll find out, I guess, a little bit in the next 24 hours. Bramo, final thoughts?
Well, just this idea of soft landing island, that seems to be the takeaway. My takeaway is nothing's changed from the economic data this week. So it really goes till next Wednesday and NVIDIA reporting earnings that really becomes the next big stopping point at a time when a lot of people are looking at the shifting sands of technological shifts, et cetera, that might create something new that some of the economic data just really hasn't. This economy just keeps chugging along.
And there's lots of concerns around the economic data. Are people picking up the phones? And some of them, is it coming out on time? The revisions, look at PPI, how strong those revisions were. So when you look at potentially maybe what corporates are saying, Walmart this morning I thought was great. This is one of the biggest companies in the United States and showing that the higher end consumer is looking for deals. Inflation is biting everyone across the board. And that for me was the big point.
What do we think of Jamie in the last hour? What was your big takeaway from that one, Lisa?
He is the ultimate politician, even though he doesn't want to be in politics. I mean, this is becoming the new ambassadors for the United States in a way that a lot of politicians in the U.S. aren't. And I find that the most interesting in some of these international tours that we hear from a lot of chief executives.
Absolutely. We saw that in Davos. Remember, it was him behind the scenes with Zelensky having this catch-up, him and a number of other executives. But what job, if he was a politician, would he be applying for? Francine, of course, asked about Treasury Secretary, which even in Washington, D.C.
State Department.
I was there last week, and his name was brought up again as someone who potentially be Treasury Secretary. But then he talks about nuclear blackmail, China not a natural enemy, talking about India. I felt like he was going over to the State Department, the Defense Secretary.
Take a pick.
Well, I think at this point, this is somebody who can have that sort of bird's eye view, and will have that bird's eye view. There is this issue of who is going to fill the White House, and we talked about that with Libby Cantrell, and I will just say that corridor between Washington, D.C. and New York has gotten very busy.
Yeah.
You can feel it as people try to kind of gun for different
I'm not sure it's Wall Street, it's the court downtown. It's not Wall Street and DC in that corridor that's got busy. You come up here to kiss the ring. That's what's happened the last couple of days. Yeah. Absolutely, yes.
It's quite the lineup.
Absolutely. Coming up tomorrow, here's your lineup tomorrow morning. Jeff Yu of BNY Mellon, Megan Robson of BNP Paribas, Mohammed Al-Erin of Queen's College, Cambridge, and Morgan Stanley's Seth Carpenter. All of that and more from New York City. Thanks for choosing Bloomberg TV. This was Bloomberg Surveillance.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
October of 2019, you surprised the business world by stepping down as the CEO of SAP, a very, very large company whose value had more than doubled during your co-CEO position and CEO position. And you took a position with a much smaller, less-known company, ServiceNow. Usually people, when they leave a job, they go to a bigger company. Why did you go to a smaller company?
Well, I saw the future and where it was going. First of all, I want to say I had a great run at SAP, and it was a pleasure taking them from 39 billion to 163 and really inspiring lots of people and customers, and it was a wonderful experience. But after 17 years, nearly 10 as CEO, I was ready to do something different. And when I saw ServiceNow in the marketplace, I knew what it was, and I knew what it could do. And I knew with my background, I was a pretty good cultural fit for what ServiceNow needed to scale it.
So let me ask you, what does ServiceNow really do? Tell me in simple English language that everybody can understand. What do they actually do?
40% of the CEOs say today, if I don't digitize my operations, my company will no longer be viable in less than a decade. So we were the IT backbone for companies all over the world. How do they manage their assets, run their operations, secure their operations, all things digital having to do with IT.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg.
Live from New York City for our viewers worldwide, I'm Matt Miller. A slew of economic data this morning doing nothing for markets. We're seeing very little movement after we hit an all-time record on the S&P yesterday. The countdown to the open starts right now. Coming up, stocks sitting at record highs with Fed speak in focus. We have a mixed bag of economic data doing little to move the needle, and Walmart delivering a beat thanks to price-conscious consumers. Let's start with the big issue, mounting signs of Goldilocks.
Retail sales have been cooler. The labor market looks to be moderating. Perhaps more consumers are headed to Walmart to get that better discount. If we are at the start of a bumpy ride lower in inflation, a Goldilocks pulling in the economy, that's an environment that the market will welcome. What they don't want to see is a more rapid decline, and that's what we're on the lookout for. We don't see it yet.
Joining us to discuss now is Morgan Stanley's Caterina Simonetti, as well as Richard Bernstein of RB Advisors. I think we still have to talk a little bit about yesterday's data, not yet today's. Caterina, what do you make of the perceived slowdown in inflation, or I guess the actual data slowdown, although it's only obviously one data point?
Well, Matt, we will take any good news we can get. And of course, you know, Fed is so focused on inflation, and we appreciate the fact that this is a move in the right direction, but we're nowhere close to their target rate of 2%. So what this tells us that they're very much still staying the course. We most likely are going to get few rate cuts this year, but the timing of it, that's really the question, because it's a data-driven Fed. They're going to look at the numbers, and as much as we appreciate the decline in the CPI, you know, it was just marginally lower, and we would love to see, you know, a better numbers. And I think Fed, you know, is looking very closely at this before they take an action.
Richard, what do you think? I mean, encouraging, I think, is the way you described it in your note. Obviously, we've had other consumer confidence, you know, labor data that hasn't been great. How do you see the Fed's position right now?
So Matt, I think the interesting point is in your preamble to this segment, there was a whole discussion about the soft landing, and I think economists continue to use the word landing and just refuse to consider that maybe the economy isn't landing, that the nominal economy is actually still strengthening. I mean, corporate profits growth is still revving up. You've had, you know, inflation today. Yesterday we had an encouraging number, but today we had a discouraging number with import prices. The core import prices are up year on year now for the first time in, I think, 14 months. So I think there's still a chance that the economy isn't landing, that we're still in the process of accelerating to some extent.
But we have had, we have had earnings numbers, I think, that support that argument, Richard. You know, 3 quarters in a row of earnings expansion after contraction for the previous 3 quarters. How does it look to you from a stock market perspective? I mean, we've already had a really decent run yesterday at an all-time high on the S&P.
Right. So Matt, I think the mistake that people can make right now is thinking about the market and thinking that there's one market out there, when in fact the market remains very bifurcated, where we've got sort of the Magnificent Seven, Fabulous Five, whatever it is, and then you've got almost everything else in the global equity markets. And I think the story that I think is the real investment story, the exciting investment story that's out there, is the broadening of profits growth, the broadening of the markets. I mean, in the United States right now, there are over 170 companies growing, or just in the S&P 500, growing earnings 25% or more. So is there anything unique about the Magnificent Seven? That's the question I think every investor should be asking.
And about the U.S., right? I think it's important that you mention that, because we see investors now looking for outperformance in other regions. Caterina, are your clients, you know, looking to move out of the U.S. and rebalance a little bit internationally?
Not so much, but I agree with Richard that as we decipher the earnings, it's really important to realize that some companies, especially the smaller ones, are really struggling in the higher interest rate environment and inflation that is affecting the margins. And others are seemingly very effective controlling their costs and staying profitable by cutting costs and being, you know, very frugal in the way they operate their businesses. But then there are also companies that are thriving because they're competitively positioned and there is a strong demand for their products. So we see the opportunity not so much on the US versus international level. We see the opportunity more on the stock, individual name level versus than even on the sector level. We continue liking materials, industrials, consumer staples, but it is really that differentiator that makes a difference where we look at the companies that are competitively positioned and are going to stay competitive, especially given the AI profitability factor, versus the companies that are going to be affected by inflation and high interest rate environment in the long run.
All right, so let's get back to that in a moment. Talk about stocks specifically, talk about sectors. Right now, though, I want to get to the economic data quickly because there was a lot out this morning, and Fed speak continues to roll out as well. Here's the latest from Minneapolis Fed President Neil Kashkari.
How much downward pressure is monetary policy putting on the economy? That's an unknown. We don't know for sure. And that tells me we probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
Bloomberg's Liz McCormick joins us now for more. And Liz, we've had, days of economic data that we're all watching today, a full page on EcoGo and more Fed speak. What do you make of the positioning right now, the FOMC?
Yeah, I think like Neil Kashkari was saying, many of them are signaling what the best policy is now is just to wait, right? They think they're restrictive, but they're not quite sure. It's kind of like do no harm is waiting. But the market is pretty much priced for that they'll cut twice. In the March dot plot, the Fed signaled, but it was an uber close call. The median was for 3 cuts, and I think the market believes that the next update in June will show 2. But like we have Loretta Mester speaking later today, and last month she had in an interview that she said she was at 3 cuts, but it was a close call. So, I think we're really watching, to see how much more hawkish the tone of the Fed speakers sound. But I don't think the market's willing to go too far over its skis yet because, we're kind of priced to perfection in a sense. 2 cuts seems reasonable. I know Bloomberg Economics says July is still a possibility. That's their call. We're very low odds for that. Most of the pricing is for the first cut to come in September. But yeah, we had a plethora of data today. It didn't kind of move the needle too much either way, but CPI, as we know, helped a little. So we're still in kind of wait and see mode.
Richard Tang over at Roco says there's not going to be any cuts. And I have to chuckle at someone forecasting a move by the Fed in September, right? 2 months before a presidential election. Seems like something they wouldn't do. How can they move? Aren't their hands tied ahead of the, big political event?
Yeah, now, of course, Matt, Chairman Powell was asked that specifically at the last press conference, and as is his job, he said, no, we'll do whatever. But I think you're right. There's a lot of people calling it this jump risk. I think the folks at Bank of America said that if they don't get one in too soon, you're right, that September, of course, November is just not a good time. That's why, there's a decent amount of forecasters saying 1 cut this year in December. So I think you're right. Fed doesn't want to say, politics ever factors in, but it does get stickier as the election gets close. So, we have to see. I don't think, I remember talking to Richard Tang years ago. He's been at a few shops. There's many who say we might get nothing this year, right? And the Fed, waiting, let's see how it goes. They could be waiting and waiting and waiting, right? So, that's not impossible that there's none that come through.
Yeah, all right, Liz, thanks so much for joining us. Liz McCormick there talking to us about the Fed. I want to kind of get away from the parlor game of what are they going to do and talk about, Richard and Katerina, you both bring up, what companies are doing. But you can't obviously divorce yourself completely with whether or not Fed policy is restrictive. Do you see it that way, Katerina? Because certainly asset prices haven't been held back by Fed policy. What about companies' behavior?
Well, certainly we cannot divest ourselves from the news, especially that, given that this is all we're talking about. And investors are troubled by the uncertainty that all of this brings. And, they can't help but question what it means for their portfolio. And in our view, the biggest concern on the portfolio level is this unintended concentration that the performance of last year, and especially the Magnificent Seven, is bringing, because some companies, especially the large ones, are seemingly unfazed by the high interest rate environment. And some investors are finding themselves being concentrated in those names. And we can't forget that even though some of them are fantastic companies and it's easy to almost fall in love with them at some point, we can't lose track of the importance of diversification and risk management, especially right now when there's so much uncertainty about the Fed action.
Richard, what do you think? I mean, you mentioned the Magnificent Seven. Their earnings growth has been fantastic. If you take them out of the S&P 500, what you have left is pretty much just treading water. Do you like certain other sectors? Are they undervalued?
Oh, Matt, I think it's pretty easy to make the argument that most of the global equity market is actually quite cheap. That doesn't necessarily mean anything unless earnings are starting to accelerate. And I think that was my point before, that earnings are starting to accelerate. You know, value investors always want a catalyst. The catalyst is there. The question everybody should be asking, and this is something that Katerina sort of alluded to before, why isn't the market reacting the way it normally would? And the answer is, I think economists have completely missed the boat on this one in saying that the Fed is so restrictive. If the Fed is restrictive, why is, since I'm on Bloomberg, why is the Bloomberg Financial Conditions Index showing that despite raising rates 500 plus basis points, financial conditions have eased? That's not supposed to happen. We see this every day. We see it in the meme stocks, tons of liquidity. We see it in the junk bond market. Spreads are very narrow. Institutional and financial advisors are daily being offered tons of private debt deals. Where is this tightening of financial conditions that would argue that the Fed has tightened too much and should be easing? I would argue it's the exact opposite, that despite 525 basis points, they haven't tightened enough to get financial conditions to tighten to meaningfully affect the economy.
It's easy to make that argument. I wonder if it's being made inside the Fed. Of course, Powell, continues to say that policy is restrictive, but do you think there's a chance, Richard, for another rate hike?
I don't want to overplay my hand here because of some of the issues you were talking about before with the election, and they don't want to appear political in any way. Right. So it's not that there's that, but I think if you want to take a long shot bet, and I emphasize long shot bet, I don't think anybody should use this as a baseline. Maybe the Fed's going to have to start tightening again. Maybe that's in early 25.
What do you do baseline after the run-ups that we've had, Richard? I mean, if you have new money coming into this market, how much of it do you put to work in stocks after, a 10+% gain year to date?
Well, I think to Katerina's point before, I think if you put it into stocks, Matt, using your word, and you put it into an index fund, I think you're going to be very, very disappointed, not only over the next year and a half, you could be disappointed for a decade. We could have another lost decade in equities because the index is so dominated by these large cap companies, these 7 large cap companies. However, if you're on the other side of the seesaw, so to speak, if you think of that analogy, I think the next, 1, 3, 5, 10 years could be very, very rewarding, but everybody's loaded up on the 7 companies thinking that AI is the wave of the future. We have to be there, everything else, and ignoring the breadth of opportunities in all these other sectors and industries.
Katerina, what's your take on, if I give you new money to put into this market, obviously we've run pretty far, pretty fast. On the other hand, people like Brian Belsky from BMO, who just raised his target on the S&P to 5,600, say momentum is hard to ignore.
Well, absolutely. I cannot agree more. And what we do not want to do is stay on the sidelines, because as comfortable as 5% yields in the money markets are, we have to remember that just a little bit over a year ago, we were looking at 1/10%. And this is a variable rate. So the opportunity is in the stock market. Now, we absolutely favor quality. We favor large over small. We tell investors to expand their time horizons and have realistic expectations and stay true to their asset allocation. But this market might deliver returns that are not quite exciting as we have seen in the past, because inflation is here, higher interest rates are here, and they might be here to stay for extended time horizon. But there is still more of an opportunity to be profitable, on the side of the stock market than remaining on the sidelines and missing this. There is volatility, but there is also opportunities on the especially on the single stock names.
Single stock stories are what I think drive the interest the most. Katerina, thanks so much for joining us. Katerina Simonetti there, as well as Richard Bernstein, talking to us just 15 minutes ahead of the open today. Of course, we're already at an all-time high on the S&P 500, and let's get a look at what stocks are moving, which individual single stock stories are moving ahead of the opening bell. For that, we go to Abigail Doolittle. Abigail?
Matt, we have quite a few single stock names, big-time names, moving in a pretty big way. Starting off with the shares of Walmart. This stock, I believe, is on pace for its best day since July of 2020, up 5.8% right now after they put up 3.8% jump in same-store sales. They also boosted the full-year outlook just slightly, and it looks like wealthier shoppers are going to Walmart, really looking for essentials and discounts. Chubb also up sharply, up 6.9%. A bit of a mystery has been solved as Warren Buffett's Berkshire Hathaway was able to reveal a $6.7 billion stake in the insurer. It had been hidden before. The SEC had not forced them to reveal that, but now we do know that that is their stake there. And then Deere, the odd stock out, at least on this board, down 5%. They cut their annual profit outlook, and apparently, Matt, farmer demand is slowing the most since 2006. It's expected to be down 26% this year.
Yeah, income, farmer net income down 26%, the biggest drop in like 2 decades. It's a huge delta, and I think, you know, such a fascinating story for Deere, but obviously Walmart as well. Everyone pays very close attention. Abigail, thanks very much for that. Coming up, we're going to hear from another person that people pay very close attention to. JP Morgan CEO Jamie Dimon speaking with us with Bloomberg at the bank's annual Global Markets Conference in Paris. We'll give you part of that next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
The JP Morgan Annual Global Markets Conference is underway in Paris. The CEO, Jamie Dimon, sat down with our very own Francine Lacroix.
I wouldn't call it turbulence. We've had good, healthy markets for quite a while. They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets which are kind of wide open. That's all good. It doesn't tell you what the future is going to be. I mean, I could point a lot of times in history where that was true, and the next year it wasn't true, and so we'll see. I don't pay as much attention to monthly numbers as most people do.
I know. So what do you think the future is for inflation and interest rates?
I'm a little more worried about it. I mean, we've had very big fiscal deficits, and I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary. The green economy, the remilitarization of the world, the infrastructure requirements, the restructuring of trade. fiscal deficits. So I think there are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation a little bit higher, and maybe that'll slow growth. And obviously geopolitics is a whole different issue. That could be determinative in what our economy does next year, and we're just not going to know.
But so does that mean you think it's 50-50 whether the Fed cuts or hikes at next time around, the next move?
I really don't pay that much attention to that. The Fed will have to follow the data, and I don't know what the data is going to say, but I think they are doing the right thing to be patient right now. See what's going to happen. They may not know for a couple of months.
But no big correction. I mean, if you don't pay that much attention to it, it means you're not worried about anything.
No, I'm worried. I just said stocks are very high, and I think the chance of inflation staying high or rates going up are higher than other people think. So I think the chance, my view is whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
In the U.S. or globally?
Well, I'd say in the U.S., but also that could affect globally, yeah.
And so what does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
Where does that happy talk come from?
Low rates, central banks are going to reduce rates. Maybe the geopolitical things disseminate, don't cause problems, and so the future isn't predictable like that. So I'm a student of history. I've watched all the inflection points. If you go back, my dad was a stockbroker. I go back to the booming markets of 72 and the collapse of 74. The healthy markets of 80, the collapse of 82. The 87 market crash, the 1990 real estate crash, and almost all of them were not predicted the year before. So I look at these factors that drive these things. They're not always known. As a company, we prepare for all of this. We can serve all our clients regardless.
But what do you see as the main stress right now? Because if it's geopolitics, we talk about it. It's just not really priced in. Is it distress? Is it something actually going under that you worry about, or just multiple factors coming in at the same time?
No, I think geopolitics could create the main stress that we're worried about in terms of oil and gas prices, trade alliances. But I think the surprise would be higher rates because inflation didn't go down. That inflation's been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise. If you had higher rates and God forbid stagflation, you'll see stress in real estate and leveraged companies and some private credit and things like that.
That was JP Morgan CEO Jamie Dimon and Bloomberg's Francine Lacroix from the JP Morgan Global Markets Conference in Paris. Coming up, the morning calls, and then later we're going to talk to BlackRock's Jean Boivin joining us around the opening bell for his outlook on equities. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around prevention.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show. This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
This is the countdown to the open. I'm Matt Miller. Moments away from the start of trading, we're seeing a whole lot of nothing in terms of The index moves, but a lot of individual movers. The open in, I guess, 12 seconds from now. One of the stocks we're going to be watching at the open, of course, is Walmart, raising its outlook after gaining market share from price-conscious consumers. They're seeing wealthier consumers move down. A different story over at Under Armour, under pressure after missing estimates. And we go back over to Abigail Doolittle. She's got more on UA. Abby?
Yeah, well, let's start out with the shares of Walmart. We're really looking at a tale of two stocks and retail companies here between Walmart and Under Armour. Walmart right now on pace for its best day since July of 2020. That's the degree of the buying power. And I think that investors are relieved that this company put up a same-store sales that jumped 3.8%, so very solid in the quarter that was. And looking ahead, they did boost that outlook a little bit, as you mentioned, just a little bit. And it looks as though, as you also mentioned, some wealthier consumers who may not normally shop at Walmart, they're looking for breaks and discounts, so that is helping to drive Walmart sales. It's interesting, though, their ticket price, 4.4% growth, was actually down on a quarterly basis, a sequential basis. On a year-over-year basis, there was a little bit of growth, but it looks like more of that was volume. As for Under Armour, we are looking at the worst day, actually just since March 14th of 2024 of this year, so about 2 months. So this stock has been under some pressure, and they, of course, missed their adjusted earnings forecast missed, but they're also talking about doing a restructuring that will include charges of about $70 million to $90 million that will also have some employee severance and benefit costs in there. So lots of uncertainty around Under Armour right now, down nearly 8%, down more than 8%, whereas Walmart enjoying a nice 5.7% boost on that strong quarter and outlook.
But also, Abby, I mean, hugely different scale, right?
Yes.
I mean, Under Armour has like 8,000 employees and Walmart has more than 2 million. I thought it was interesting that Walmart had a 22% gain in online sales. So a lot more people are using Walmart online, and it feels like that's the biggest driver of sales growth.
Well, that really speaks to the infrastructure that they put into place, over the last several years. Because when you think about Walmart, or at least when I do, I think of people actually going to that big box retail store and picking things up. But they have that infrastructure, and people want the convenience coming out of the pandemic. If they can get the deals and the convenience, they're going there. But point well taken on Under Armour, much smaller company, niche area, and perhaps the restructuring will help them achieve some of the moves that they're looking to make to boost numbers and probably the stock. It's success.
All right, we'll keep looking at it. Abigail Doolittle, thanks very much for that. We're going to have more on Walmart with Greg Mellick of Evercore ISI in just a little bit. Right now, let's take a look at shares of Chubb, getting a big boost from Warren Buffett, the stock heading for its best one-day gain in more than 15 years after Berkshire Hathaway revealed a $6.7 billion stake in the insurer. Alex Semenova has more. Alex?
Hey, Matt, good morning. Well, the months of suspense over Warren Buffett's mystery stock are finally over. Berkshire Hathaway had previously kept this position private. The SEC had allowed it to keep it confidential in regulatory filings, and it now disclosed its stake in Chubb on Wednesday, a position it had been building since 2023 to the $6.7 billion stake that it is right now. Chubb's stock is up about 6% right now. That's no surprise given how closely people follow what Warren Buffett does. Berkshire is, of course, deeply familiar with the insurance industry, holding stakes in several companies in the industry, including Geico. If this gain holds, Chubb is set to hit its highest level on record. Shares were up about 12% year-to-date through yesterday's close. Bloomberg intelligence analysts said that this is a classic Warren Buffett investment, and Evercore ISI said that this is giving the stock a slight boost, given such a large investment at this point in the cycle. Matt?
All right, Alex, thanks very much for that. We'll continue to watch, obviously, everything that Berkshire Hathaway does. Let's turn back to earnings, though, and focus in on a company that I think we used to have a little bit more under the spotlight. Cisco, I remember when all we ever talked about was Cisco. They're giving a solid sales and profit forecast, indicating customers are beginning to invest in their computer networks again after Chuck Robbins has made a bit of a pivot. Katie Greifeld is here with more. Katie?
And initially, I mean, traders were pretty excited about this. Cisco shares were higher by about 5% pre-market, but that enthusiasm is going away right now. You can see shares down about 1.4%, even though, like you said, it was a pretty upbeat forecast when it came to sales and profit, like you said, suggesting that maybe that corporate spend is starting to pick up. Let's get into some of the numbers here. For the current quarter, forecasts were kind of in line with estimates. I would say sales will be between 13.4 billion to 13.6 billion. That compares with the average estimate about 13.5 billion. It's a similar story if you take a look at profit, expected between 84 to 86 cents a share. The prediction had been for 84 cents. For all of fiscal 2024, though, a little bit of a brighter story there. Revenue expected between 53.6 billion to 53.8 billion. Average estimate is for 53.6 billion. But the thing that the sell side has been excited about this morning, reading through some of the notes, is Cisco's progress on improving its relationships with hyperscalers such as Microsoft, such as Google. Of course, they had been really relying on their own in-house networking equipment for cloud computing. But when it comes to AI, Cisco now has a line of sight to $1 billion in orders from hyperscalers and others investing in AI. Again, that had been giving the stock a boost pre-market. Different story in the cash trade. You can see Cisco shares down about 1% or so.
By the rumor selling news. Okay, thanks very much, Katie Greifeld, for that. Tune in to her interview with the CFO of Cisco, Scott Herren. That's at 10:30 a.m. Eastern, right here on Bloomberg TV. Turning now to China, JD.com reporting stronger than expected profitability as Alibaba's profits were seen as weaker. Ed Ludlow joins us from the West Coast for more on Chinese tech stocks. Ed?
Yeah, good morning, Matt. We've actually had an interesting change of direction on JD.com. We're down more than 2%, having opened up higher by more than 2%. It's a story about basically retail strength. JD's top line growth was 7%, compare and contrast with Alibaba's core e-commerce platform, which had pretty sluggish top-line growth of 3%. And we know that the story in the quarter, which included key Chinese holidays, was JD.com heavily discounting, cutting prices. But the bright spot in their earnings is also their profitability. It shrunk by less than expected, in part because of cost discipline. And, you know, the narrative around the Chinese consumer, the reason we pay attention to both JD.com and Alibaba is that they're seen as bellwethers for the strength of the Chinese consumer and therefore the Chinese economy. What Alibaba had told us about 24 hours ago is that Chinese consumers have a lot of savings, they have a lot of cash, but it's a highly psychological or sentiment-driven market. And so therefore, it seems like we're learning the winners here. JD seems to be doing well in the online or e-commerce space. Analysts really flagging its strength in the electronics category, core retail categories. Alibaba didn't do as well. There is competition there from Meituan, Pinduoduo, and names like that. We are pairing our losses on JD.com. The other big story you will have seen on the Bloomberg terminal and Bloomberg.com is Michael Burry of the Big Short fame, right? Cyan Asset Management boosted its stake in JD.com by 80%, or its position, making it its biggest holding, but it's not doing much for the stock today. Alibaba, second biggest holding.
Ever since Christian Bale gave that amazing performance, I pay attention to everything he has to say. What is it, Cassandra on X? Cassandra?
Yes, exactly, Cassandra on X. Read the story and look at what he's been buying into in China.
I already read the story, Ed. It was among the most read this morning, and I go through that list pretty religiously. Ed Ludlow there from B-Tech. You can catch him on Bloomberg TV just after Katie Greifeld steps off the set. Joining us now is Jean Bovin, head of BlackRock Investment Institute, to talk to us about his outlook for stocks. And Jean, it's a new record that we hit yesterday, but we are still hearing people come out with even higher targets. I think Brian Belsky now says 5,600. What do you think of the overall of the index?
So we have been, overweight U.S. equities coming into this year. I think there are powerful force at play that's going to drive returns. We've seen a very strong earnings seasons coming through. So the first part of this year for us was one that would be constructive. This is kind of playing out despite a little bit of wobble in April. So this is, I think this is in line with this broader context. We are still thinking, however, that a lot of it is driven by narrative about the macro environment, right? Inflation and so on. We've seen that yesterday, that there was a trigger And that is an extremely volatile narrative story. So I think that's the key lesson this year, is that this keeps changing, flip-flopping. Some enthusiasm now, but I don't think we can expect that to stay, stable through the rest of the second half of this year. And we think, the sum total of all that is we are in a higher rate environment for longer, even after the print yesterday. So I think this is constructive, but it's at the same time we're going to see some bumps coming from inflation not being as easily brought back down to 2% as we go through later in this year.
Yeah, so, John, I love to look at the single stock stories. I hate to get drawn into the macro debate, but you can't really help it when it looks like the market is placing a bet still on rate cuts, even though we're very far away from the Fed's 2% target, and we're in an election year with a Fed that doesn't like to get political. Is the market wrong here?
Yeah, so I think well, the market has been changing its mind pretty aggressively over the last 6 months, right? So since December, partly because central banks themselves have been quite a bit changing their tune. So I think now we've seen a Fed in particular over the course of the last few weeks that have sounded a lot more cautious on inflation being under control, a lot more hesitant. They can always flip-flop. They have flip-flop, but I think the bar for them to go back to their optimistic scenario is high. So as a result, I don't think July is very likely at this stage, even though the market started to get enthusiastic about that yesterday. I think the inflation story, even though this is a positive development yesterday, the inflation story is one where underneath all of it, there's a lot of persistence. There's a lot of persistence in services inflation that hasn't been resolved. What we saw is an unwinding of the upside surprise earlier this year, but we have unwound to a level that is still too high in terms of service inflation. So I think it's going to be hard for the Fed to make a case of aggressive, quick cuts from here, especially how they've changed their tune.
Or any.
But it's not impossible.
I mean, loosening financial conditions at a time when financial conditions are already so clearly loose. What do you think about the corporate earnings story? I mean, Jess Metten wrote a great piece earlier this week about how analysts are pushing up earnings expectations after the first quarter was so well received, and we've had 3 quarters of earnings expansion after 3 quarters of contraction. But how does it look, for example, the S&P, if you take out the Magnificent Seven? How does the 493 look in terms of earnings?
Yeah, so I think this is still very much a concentration story, or at least that's the way we look at it. So we are, as I said, we're overweight U.S. equities. We've been positive on risk in this environment, but it's entirely based on the view that the AI, what we call a mega force, the AI mega force, is very powerful, playing out, and we believe in that. So it's concentrated. That's what drives the market. I don't think we have a strong conviction on things necessarily broadening out. And when you see these quarters of earnings season like we've just gone through, there is momentum building up in earnings expectation that comes out. So I think you want to be a bit careful and extrapolating too much. I guess we shave some of these optimism to some extent, but very much believe on the concentrated story here on the AI, which will morph into something else beyond the Magnificent Seven. But it's not a broad-based macro story lifting all boats at the same time.
What about foreign stocks? I mean, I heard the argument on the MLive blog, Bloomberg's MLive blog made this morning, I think, that it's a great time to hedge against risk because we're in this Goldilocks environment, but you're going to see growth really more abroad than the kind of concentrated U.S. win story that we've seen lately.
Yeah, so I think, within the DM world, we are pretty excited about Japan. And I think that at this juncture, exactly, I mean, we believe in AI in the U.S., but diversification is important in this environment, particularly because we think this is an intrinsically more volatile environment. And Japan is pretty interesting in that context. On its own, I think has a very, bullish story that is with a central bank, unlike any other G7 central banks, that's going to be supportive of the market, in our view, for the quarters to come. And it has a micro kind of governance story that is happening as well. So Japan stands out and is attractive. And beyond that, I think, when you look on the relative valuation basis or just on valuation basis, EM stands out as well, the EM emerging markets. And when you think about tactically, but also more on a 5-year horizon, where valuations matter more, I think that starts to build to an interesting case. So yeah, I think there is now a building case for diversifying away from within DM, away from the U.S. maybe to some extent, even though U.S. is attractive, and away from DM to EM.
Jean, great to get some time with you. Thanks so much for joining us. Jean Bovin of the BlackRock Investment Institute. Coming up, price-conscious consumers flock to Walmart.
I think the real story here is actually below the top line, though. We started for the first time in a long time really strong EBIT dollar growth ahead of sales growth. So starting to leverage in the P&L is really something that the long-only community has been really waiting to see for Walmart. So a really impressive print and probably was a pretty tough quarter for retail.
Good for Walmart. The shares hit a record high. We're breaking down the numbers when we come back. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
I think the real story here is actually below the top line, though. We started for the first time in a long time really strong EBIT dollar growth ahead of sales growth. So starting to leverage in the P&L is really something that the long-only community has been really waiting to see for Walmart. So a really impressive print and probably was a pretty tough quarter for retail in the first quarter. And we'll get more results in the next couple of weeks, but we're pretty happy with the numbers.
Walmart benefiting from a more cost-conscious consumer, and I think online sales as well. Pretty amazing. Walmart shares hitting a record high on better than expected results, with upper income households driving the gains. Joining us now to discuss is Evercore's Greg Mellick. He has an outperform rating and a $67 price target on the stock. Greg, I think it's a fascinating story, especially for me, the juxtaposition with Amazon, because, you know, pre-pandemic, Amazon was a cheap place to shop, and I have a very cost-conscious wife. Now, Amazon's prices have been floating higher, and she's started to look at Walmart online, which I always think of Walmart as a place you walk into and hang out in. Is that a huge part of the same-store sales growth that we've seen?
It's a big part of it, and I would say, and even Amazon recognizes this, the U.S. consumer is extremely focused on value. And so whether it's Amazon trying to get more products to people faster, Walmart is doing exactly the same thing, and they're really leaning into their strengths, which have always been that strong value, and now layering in convenience and speed of delivery, and that's bringing new customers to them and customers they had before coming more frequently, shopping categories that maybe they haven't before at Walmart. So they're sort of winning on three fronts, and that's why it's one of our top names and has been this year.
Abigail Doolittle was pointing out earlier that, you know, sequentially they had a change in the average ticket price, but if you look year over year, it's zero. How do they do that when inflation is so much higher?
Yeah, average basket, that 3.9 comp is particularly impressive when you consider that it's all traffic. And that's positive traffic on traffic a year ago that was up, I think, 2.5%, 3%. So that, to me, is the core underpinning of Walmart. It's you're getting more customers coming more frequently. You know, what inflation is going to be what it is, and they're doing as good a job as they can is trying to suck that out of the system. So overall inflation and the same SKU inflation in the basket, they said was just 40 bips in the quarter. So that's a couple hundred bips below overall U.S. CPI. So Walmart's doing their part to try and squash inflation, but at the end of the day, there's only so much you can do. But they're as a result, their strong value proposition is just winning more customers.
In terms of the consumer, I mean, it's great if you can get consumers to move down, I guess, but ultimately you want growth in all of the segments. Can they do that? Can they keep doing that?
I think you can. I think it's not the key about the Walmart story, and to me why it's changed so much in the past 12 to 18 months, is it's no longer about just getting trade down or like people that have to go to Walmart. They're people that want to go to Walmart. It's having 400 million SKUs available through third party on Marketplace. It's getting Walmart Plus memberships to grow. It's getting people to sign up for Sam's Club. Sam's Club, again, you showed the numbers there before, but that was also a comp that was about 100 bips better than we thought. So they're using technology and their strong, historic, low-cost, everyday proposition to bring convenience and speed to consumers, and that's resonating with all income groups.
I'm zooming through your bio on the Bloomberg here, Greg, and looking at the stocks that you cover. I don't see Amazon here. Do you think of the two as direct competitors? Would you choose one over the other?
Well, my partner on it, Mark Mahaney, our internet analyst, we agree that it's a good, Amazon remains a winner. We've got an outperform on it. In our top 5 portfolio, though, I would say that we run across retail. We don't have Amazon in it, even though we think it has nice upside. We think the risk reward on Walmart here is frankly better. At least that's my opinion. And I think it's not an either or. I mean, both combined now, Amazon is up to about 10% U.S. market share of retail, gross market value, and Walmart's about the same. So we could be sitting here 3, 4, 5 years from now talking about, wow, how did we just miss that Amazon and Walmart went from a combined 20% share of U.S. retail to 25 or 26%. All right. So to me, it's not an either or. They're both showing that if you put together good prices, great assortment, and faster delivery and speed to help the consumer, that resonates with everybody.
All right, great to get some time with you, Greg. Thanks so much for joining us. Greg Mellick there over at Evercore ISI. Let's get some breaking news now. For that, we go back over to Abigail Doolittle. Abby?
Indeed, Matt. We do have the shares of UBS trading down about 1.4% amid the headline, the breaking news that they are, UBS, considering a U.S. CEO role for Rob Karofsky, who is currently their head of their investment bank. This is to compete more so with some of the other big banks on the wealth management side where there are annuity-like returns. We don't know that this will happen yet, but UBS is considering a U.S. CEO role for Rob Karofsky. It would be a big strategic revamp.
Got it. Abby, thanks very much. This is Bloomberg.
the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Here's your trading diary. Fed Vice Chair Michael Barr testifying before the Senate. That's at the top of the hour. More Fed speak throughout the day with Harker and Mester on deck. And the J.P. Morgan Global Markets Conference continues in France. We'll have interviews out of that for you. Finally, we round out the week with Richemont earnings. We'll see how many expensive watches rich people continue to buy. This is Bloomberg.
Names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable. Not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
This is Bloomberg.
Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming on YouTube. Thank you. The first assist of the day goes to John Tucker.
So basically, he started the show and didn't have his mic on.
Broadcast 101. Turn mic on.
You know, it's Thursday. It's raining.
And how many years have you been doing radio, John? Just so I can give you credit.
40.
40. Very
So
good.
he
So
knows
there we go.
this
So he knows how to do this stuff. All right, we got some good stuff coming up here. Earnings. We're going to break down. First, Jen Bartash. She covers Walmart, and they had some really good numbers out today. Stock hitting an all-time high. We'll break it down with her. And then really interesting conversation. Rich Hill, head of real estate strategy and research at Cohen & Steers, to discuss the latest on commercial real estate. And Alex, I saw a note out of B of A yesterday, and they had a chart of office occupancy. And obviously, it plunged during the pandemic. It came back. But they're saying at B of A, this is the new normal. And you know what the number is? It's about 50%.
Here's my
That's
question
scary.
with that. When do we see that really unfold? I've been hearing about this ready to unfold for years, and it hasn't sort of hit. I mean, what wound up happening with First Republic, for example, was, that was rent-controlled apartments.
Yes.
That wasn't CRE. So I'm waiting for the shoe. Where's the shoe? How big is the shoe? When is it coming?
Exactly. From what I understand, it's going to be on the regional bank side. But we'll see. Anyway, we'll check in with him. Pat Palazzola, he's going to talk to us about what's happening at Berkshire Hathaway, Warren Buffett, buying some stocks, selling some stocks. We'll get the latest there. But right now, let's kick it all off with Mr. John Tucker.
All right, and this market report being brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest at ibkr.com/RIA. So the Dow is higher, so I guess we're going to say we're on Dow 40,000 watch. After record closes for some of the averages yesterday, stocks in the early going, they right now slightly higher. Any close higher for the S&P 500 and the NASDAQ, and right now at the Dow, for that matter, that'll be a record. More Fed-friendly data this morning. It's the old bad news is good news scenario. You had jobless claims higher than expected. The housing starts, building permits, they were way off, showing weakness there in the housing sector. It does suggest Fed rate cuts or cuts are ahead. And as for equities, Jeff Yu, the senior strategist at BNY Mellon, says, you know what, the world over, the U.S. is still the place to be invested.
US tech, US productivity, that's a genuine preference because looking at the evidence, that's where the growth and the innovation and the productivity is. If I had to distill things down to one word, it's productivity growth, and that's where the US is still well ahead.
S&P 500, 3 points higher, 53.11, another record. Dow Jones Industrial Average, 12 points higher right now. That's at 39,921. The NASDAQ 100, 16 points higher. That's at 18,613. And the yields real quick, the policy-sensitive 2-year, that's up 5 basis points. That's at 477. The 10-year, 2 basis points higher. That's at 436. Best performing major industry group in the S&P 500 right now. That belongs to consumer staples, and that's where you're going to find shares of Walmart. Very good.
Thank you.
After their earnings. We'll take a deeper dive into that in just a moment. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. I'm Alex Steele with Paul Sweeney. This is Bloomberg Intelligence Radio. We are live from Interactive Broker Studio right here in Midtown Manhattan. I have one question, and it's just one. What will stop the equity rally?
Yes, great question. I mean, it just feels like the earnings are good enough.
Yeah.
The outlook for the Fed is good enough, and that's it.
And that's it. Buy
That's it.
stocks. Like I generally don't see what that catalyst is for any material downdraft, and it definitely wasn't Walmart. Let's get more with that. Carmen Reinecke joins us from Bloomberg News. I have to say, I was a little nervous going into Walmart, right? Because we got some mixed read on consumers. The survey data hasn't been great. Numbers really good.
Yeah, this is a great report for Walmart, and the shares are up about 6.7. It was up 7% earlier today. This is on record to close at an all-time high. Yeah, the sales growth was good. It boosted its full-year earnings expectations, and that's something we've talked about here before, right? Which is that this quarter matters, but what's going to happen, the full-year earnings expectations, is really paramount for companies in this earnings season. I think the other thing that was interesting here that we had sort of talked about before is the upper income households, sort of where those consumers were spending, and that is something that Walmart called out this quarter, that they're seeing, you know, those households driving a lot of gains. I also thought it was interesting that the CEO noted that the results were not driven by inflation. They were saying they're actually seeing inflation ease a little bit. The average ticket was flat. But they're also, you know, trying to keep costs down. They're shuttering smaller offices and sort of looking to lay off employees that are working from home. So I think overall looking really good for Walmart.
Well, I don't shop a lot, and therefore means I haven't been to a Walmart in a long time. But this Saturday, I'm going to the Walmart on Route 70 in Wall Township, New Jersey, just to check it out and see what's doing, see the crowds and stuff like that.
I heard this on radio. I heard that you were going there, and I'm like,
Yeah.
this is it. And you're probably gonna go buy some stuff.
I'll probably buy some stuff because they
Just
got
why
tons
not?
of stuff.
Tons
Because they
of
had
stuff.
everything.
Yeah.
So what I like, you know who's really smart, by the way? Gina Martin Adams, in case we haven't said that today. She's the one coming in like a week ago saying, hey, you need to focus on sales this quarter. I've been talking about margins for a long time, but we need to see sales come through for a lot of these companies. And Walmart sales come in better than expected. And fortunately for them, that drops down to the bottom line. You get the EPS beat. So shout out to Gina Martin Adams again for being right. What else do you have?
Yes, the other one that I was looking at this morning is Under Armour, and this has been kind of a funny, like, wishy-washy stock. So it was down as much as 8%. It's now up a little bit. I think it's getting sort of lifted by the rest of the market rally that we're seeing today. An interesting report. So the quarter generally beat, but they didn't give a very good forward guidance for 2025. So that missed the average analyst estimate. That's sort of what people on Wall Street were talking through this morning, saying that outlook is sort of not a great vote of confidence for the company going forward. They also said that they're going to do a restructuring, so it's going to cost approximately 70 to 90 million. The CEO saying that they're seizing on this moment to make proactive decisions to build a premium positioning for the brand. There's also been some movement at the leadership level here, so that was an interesting one. It was down a lot and then sort of rebounded.
I thought this was a bigger company. It's only $3 billion in market cap.
It's gotten pretty small, yeah.
Wow,
yeah.
Really pared that down. And they're also going to go into menswear, right? Did I read that correctly? Like on the call, Kevin Plank was talking about they really want to up their men's line. But like, I don't know. Do you care what you're wearing when you work out? I'm going to go with no. I could be wrong.
Sitting at a bar is what you're asking me?
Yeah, that's right. That's right.
No, I don't.
Do you need to
Those
wear Under
elbow
Armour
bands.
leggings?
Exactly.
The 8-ounce.
No, but people do, I think.
Yeah, but I don't know. It feels like, I don't know, maybe going into menswear is going to be great. I don't know. I know my husband does like 3 workout shorts he's had for his whole life. So what do I know?
I still have the sweatshirt I had in high school for working out.
Okay, see, that's
Those
kind
occasions
of what
when I
I'm
do
getting
work
at. All right, and you're looking at Deere also. Deere has a tough time. I mean, net, farmers aren't making as much money, and they can't buy the expensive stuff.
Yeah, and let's look at where shares are this morning.
So,
they were lower
Deere,
pre-market.
Yeah, we're going to get Ciolino on from Bloomberg Intelligence. He'll break it down.
So they're down just a little bit. They're down 3%. Yeah, I think you're right. It really is just like the agriculture story there. The other one that I was also looking at is Chubb. Nice. This one also trading at an all-time high. It was revealed to be sort of the mystery company that Warren Buffett's Berkshire Hathaway has a stake in, so $6.7 billion stake. Obviously, they know insurance really well, so it's a huge, I think, vote of confidence for shares. Bloomberg Intelligence called this a classic Warren Buffett position, which I think makes a lot of sense. And people had sort of been speculating on what this position, what this stake would eventually be revealed to be. So I think there was just a lot of excitement around finally getting that 13F and seeing what it was.
I always love what Warren Buffett's buying, selling. It's always a fun one.
Later this hour, we're going to check in with Matt Palazzola at Bloomberg Intelligence. He covers Mr. Buffet, and we'll break down kind of some of the positions that Warren was adding to it and taking away from.
All right, Carmen, thanks a lot. Really appreciate Carmen Reinecke joining us from Bloomberg News. Just some breaking news. The CFPB, the Consumer Financial Protection Bureau, its funding system was upheld by the U.S. Supreme Court. This is a win for the Biden administration. The agency was set up after the 2008 financial crisis, and their goal is to regulate mortgages and other consumer finance products. And in a ruling 7-2, the justices rejected arguments evidence that the CFPB, which gets its money through the Federal Reserve, was set up in violation of the constitutional provision that requires a congressional appropriation for government spending. So they are able to help, and their funding system is legal despite the fact that Congress isn't in charge.
Even for Bloomberg, that's geeky news.
Hey man, I'm just reading the headline. Hey, Mark said to break it, I'm breaking it. I do what I'm told.
Oh my goodness. I would
No, you can look at it from the political perspective as well.
Can we not do that though?
A win for the administration, the current administration, from the Supreme Court, 7-2.
Okay, well, what does that get the administration? I don't care about it, and I'm a Wall Street guy. I mean, I don't think they're getting a lot of votes because of this. You know. All right, good stuff.
But the CFPB.
Good to break that news. Well done.
Thank you. But it's all the CFPB also does things like help regulate fees that credit card companies can charge to businesses. Like there's stuff that eventually will trickle down.
All right, very good.
I do what I'm told.
Broke that news here. All right, let's head over to talk about what's happening at our good friends at Walmart. Again, a really good quarter. Some revenues beat earnings. Talking pretty. I think people really look at Walmart as kind of a read on the U.S. consumer, and that was kind of, I guess, a pretty good report there. Let's check out Jen Bartashis. She follows all the retailers for Bloomberg Intelligence. She is in Princeton, New Jersey, I'm guessing. Jen, what's your takeaway from our good friends in Bentonville?
Yeah, good morning, Paul. When I look at today's results, I think one of the striking things that is a takeaway that is beyond just the story of the higher income consumer, which everyone is focused on, is that the multiple year strategy that Walmart's been employing to change their business mix is really starting to yield results. And that's allowing them to grow operating income ahead of revenue. That's, driving profitability, and it's driving that long-term margin expansion that they think they can sustain. So to me, this is a great quarter. And yes, they do have a great read on the consumer, but it is also starting to show that all of those investments are really paying off in the way that they're evolving the company.
So Jen, I'm vowing to do a store walk this Saturday for the Walmart near me.
Right.
How do I do that? How would you do it? Like, what do I do?
Well, you drive there and then you
I'm
park
gonna get
the
there.
car.
But there's a million aisles. These things are huge.
They are, what I would say, Paul, is wander around a little, but what I do when I go into stores is I find one of the people who are picking the online grocery orders or their online orders, and I follow them around. And that way I get a sense of what it is that people are actually buying, what are they putting in their basket, and how are employees actually effectively navigating that big store. So that would be one tip I'd have for you.
That's very cool.
I like that. I'm gonna do that.
You definitely should be doing
They're
that.
gonna be like, hey, there's this dude trailing.
Yeah. Aisle 7, get that guy. Jen, when we look at the areas of mix that you were mentioning that they sort of are changing their business mix, that huge part is e-commerce, right?
It is.
If their main competitor, though, is Walmart for e-commerce, how does that evolve?
Well, what Walmart's been doing is they've added a lot of sellers to their marketplace. It's unlocking ad revenue growth. It's unlocking the ability to charge for fulfillment services. Now, these are all things that sound very familiar because they're things that Amazon, for example, is very strong at. But that doesn't mean that it can't help Walmart evolve, and it can't help make Walmart a much stronger company in the long term. I think the advantage that Walmart has is because they have that strong store base, they can help keep some of their costs to fill digital orders down, which helps them with that overall profitability profile as well.
When you talk to investors about Walmart, again, it's the stock hitting an all-time high here today. It ain't cheap. How do you talk to them about valuation? I got it like 26, 27 times on a PE basis. How do you talk to them about valuation?
Well, excuse me, when we're talking about valuation, it's really about...
Oh boy.
Are you okay, Jen?
Sorry.
You can clear your throat.
Let me explain this, because I worked with Jen for many, many years. When she starts sneezing, it's not one sneeze.
Oh.
And we all know this, for those of us that work with Jen down in Princeton. Now, as great as her research is, it can be derailed by a little sneezing fit.
And the worst thing is when you try to stop from doing it. Right?
You can't do that. You can't do that. We support you here.
All right. Well, thank you. So, to get to your question, Paul, it's really, when I'm talking to investors, it's, about where is the company headed, right? So I think one of the things that's admirable about the company, or that is really something they just do so well, is they keep their core operation tight. They're good at controlling costs, but they are not, they don't hesitate to invest in opportunity, but they also will walk away from things that don't pan out. So I think, you saw that with the announcement earlier this month about closing health clinics. At one point, they thought they might be able to, drive a big business out of that. realistically couldn't make money, closed it down. So I think that spirit of trial and error, the willingness to actually try to flex, but then know when to say, okay, this isn't what we wanted, is something that has become a strength of the company, and helps put it up as a company that justifies potentially a higher valuation versus some other strict retail peers that are really just focused on growing a retail business.
I think she's good. I think I can ask one more question.
Yeah.
I think I'm gonna do it. What Amazon has, though, that Walmart doesn't, is AWS. That's where they're going to get their bulk of their margin. That's where they get all the juicy, sexy revenue. Walmart doesn't have that. So is that so how does it sort of ramp up other revenue streams that can yield that kind of growth and margin?
That's the question of the day, right? Because you don't actually want Walmart to be another Amazon. You want Walmart to be Walmart. And so I think that when you look at some of the areas that they're doing well, especially in some of the international markets where they're playing around with it in things like fintech, those are areas where I think that there's some great opportunity for the company, without them having to try to be a cookie cutter of Amazon and have some have something like an AWS that is not natural to their current operations.
All right, Jen, thanks so much for joining us. I appreciate it. Jen Bartasha, she covers all the retail stuff for Bloomberg Intelligence, including Walmart, again, which had a really good quarter, stock up 6% here, all-time high. So good stuff for that. I think a good, little just kind of a bullet point there for if you're trying to get a sense, a beat on how the consumer's doing fairly well, at least from these results. Who we spoke to this morning, which we should have had you in studio? Paul Sankey.
I love Paul Sankey.
He is a seriously smart dude on energy. I wasn't really I've talked to him a few times, but he would be my go-to guy if I needed a real global geopolitical call on global energy.
He is my go-to guy.
Yeah.
Yeah. He's also sufficiently snarky, which I also love. So I love Paul kind of all the way around on that front. What did he say? What was his main takeaway?
I mean, I still pretty bullish on the prospects for oil here. He doesn't. He sees it at the very least staying in this range, if not going a little bit higher. But he says like the big U.S. companies have never been in better shape. From a balance sheet perspective, strategic perspective. It's interesting.
What's interesting, though, is that if you're a portfolio manager, you can't really have a lot of energy stocks in your portfolio, so you really can only have one, maybe two. And that's another reason why we're going to see all this consolidation and why they still need to keep paying out lots of stuff. Anyway, Paul Sankey, definitely read all his research. Coming up, we're going to talk about commercial real estate. Rich Hill is head of real estate strategy and research over at Cohn & Steers. We're going to talk about what's going on there. I'm waiting for that shoe, right? When the shoe's going to drop. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major averages slightly higher, but you know what? That's good enough for records after the rally that drove the S&P 500 to its 23rd record this year, and both the Dow near the historic 40,000 mark. JP Morgan Chase CEO Jamie Dimon, meantime, telling Bloomberg interest rates may be higher for longer.
We've had very big fiscal deficits, and I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary.
Signs of a steady to cooling economy. Industrial production stagnating in April, restrained by a drop in factory output. Initial applications for unemployment benefits, they fell. New home construction rising by less than forecast. Import prices beating all estimates. And then you had the Philadelphia Fed Index trailing projections. And Walmart, among the most active right now at a record. Shares of Walmart, they are up just about 7%. And we check the markets for you. Maybe I should give the averages. S&P 500, 9 points higher. That's up 0.2%. Record there, 53.17. The Dow Jones Industrial Average up 87 points. We're close. 39,995. You can throw confetti. Another 6 points.
40,000 watch.
Okay. NASDAQ 100 right now, 29 points higher. That's up 0.2%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
You got like 5 minutes. Go and, get the hats.
confetti?
Yeah.
And the hats?
Exactly. It could happen anytime here.
Yeah. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are live from Interactive Broker Studio right here in Midtown Manhattan. So here was the front page of the FT today when I logged in. Apparently, Starwood Real Estate Investment Trust, CREIT, is one of the largest unlisted property funds, and it has drawn more than $1.3 billion of its $1.55 billion unsecured credit facility since the beginning of 2023. That sounds bad. That sounds like they're in a cash crunch kind of scenario, Paul. And as we keep hearing, commercial real estate is in a really tough spot, but yet I haven't seen a lot of shoes dropping.
I haven't either. I don't know how this is going to play out. Maybe our next guest will help us out with that. Rich Hill, head of real estate strategy and research at Cohen & Steers, joining us here in our Bloomberg Interactive Broker Studio. Why? Because we're here every day, and that's how we roll. Rich, I walk from Penn Station to here every day, all through Midtown Manhattan. Now, I know this is not the world, it's only Midtown Manhattan, but there's a lot of vacant real estate. People aren't coming back. I saw via Twitter yesterday a BofA report, Bank of America research report, that kind of showed vacancies. And it seems like they're calling this new normal, which is about 50% of commercial real estate properties, they're calling that the new normal, just because that's kind of what the data is showing. A, do you agree with that? And B, what does it mean for the owners and the lenders and all that kind of stuff, the whole ecosystem?
First of all, thanks for having me in this morning. It's good to see you guys. Look, I'll begin by saying people like to talk about commercial real estate as a big singular asset class. But in reality, it's actually 18 different subsectors under a big umbrella. And those 18 subsectors can behave very differently in very different market environments. So you're leading with New York City. Yeah. You're right. New York City office vacancies are high. Retail vacancies are high. Leading with maybe retail, that doesn't actually tell the whole story, because if you actually look at what's happening with retail real estate across the United States, it's actually on a really strong footing for two reasons. I think, you rewind 10 years ago, everyone was talking about the retail apocalypse. So no one was building new retail properties over the past 10 to 15 years. So you had no new supply coming, and then COVID was a great Darwinistic event where it actually sort of right-sized all the retail properties that were maybe on the edges. Then you couple that with the fact that e-commerce companies realized that physical retail real estate can provide micro-fulfillment to their customers. The retail real estate market is actually on pretty strong footing, particularly open-air shopping centers, whether it be community centers, neighborhood centers, or even power centers.
That's a really interesting point. And you're right, we kind of lump it all in commercial real estate, we think office. So is that trouble spot office commercial real estate? And again, when is that shoe dropping?
Yeah, look, it doesn't do any good to say anything other than the facts about office. Office is struggling nationwide. By the way, we probably built too much of it prior to COVID. Work from home dynamics have tipped that. Nationwide, office vacancies are at 20%, and they're increasing from here. And so there's a lot of ways you can unpack office, though. Just like I said, maybe the truth is somewhere in the middle. It's not as bad as everyone fears, and it's not as good as everyone fears. If you look at office, new clean and green office, even in New York City, is doing exceptionally well.
Like Hudson Yards is doing well, right? And that One Vanderbilt thing.
One Vanderbilt leased up to almost 100% during the middle of COVID. So Class B and C properties are properties that were built in the 1970s and 1980s with no CapEx put into it over decades and decades and decades. I get it. No one wants to work there. So we're sort of in this weird time period where office is struggling. I want to be clear, office is only around 20% of the CRE market. It's only around 3% of the U.S. listed REIT market. But look, everyone loves a great Greek tragedy. I get it. Like, it sells clicks, it sells papers. It is a really challenging asset class, and so I don't want to belabor that.
What's the lending environment like now for real estate investors? What are the banks doing? Where are the real estate investors sourcing their capital?
Yeah, so this is probably the single most important topic when we talk about commercial real estate. The reason being that commercial real estate is an inherently levered asset class. When people buy a commercial real estate property, they put debt on it. There's not very few properties that don't have debt on it. So it is a levered asset class. And so that's actually why valuations are being pressured so much. We think property valuations generically are down around 20%. Office valuations are probably down 35%. The reason they're down so much isn't necessarily because of fundamentals. Fundamentals ex-office are on pretty strong footing. It's because the right side of the balance sheet is repricing. Both financing costs higher and the availability of debt much lower than where it used to be. So look, lenders aren't lending as much as they used to. If you look at the Mortgage Bankers Association senior loan, their loan origination index, it's close to the lowest level since we've been in 2014. I get it. A lot of people have loans on their balance sheet and they're working through those. But you made a really good point. Distress hasn't really come about yet. And I think there's a really important point, and I'll pause here for a second. Lenders and borrowers are in a pretty challenging position. So they're actually solving the prisoner's dilemma.
Meaning that a bank doesn't want to own an office space.
So a bank doesn't want to own it. They're not in the business of it. And guess what? The regulatory capital charges for owning a property on your balance sheet are actually higher than if you were just to modify the loan at, say, a 99% LTV.
LTV. Ooh, okay. Break it down for us.
Loan to value.
Okay. So what would that mean if you brought that down to 99% LTV?
Yeah. So let's assume 10 years ago you did a loan at a 50% LTV. So you had a property that was worth $10, and you put a loan on it was worth $5. So 50% LTV. Fast forward 10 years, the value of that property drops from 10 to 5, and you still have $5 of loan. That's 100% LTV. The regulators are actually incentivizing the banks to actually modify and extend loans. So some people might call it kicking the can down the road. I don't necessarily think it's kicking the can down the road. I just think borrowers and lenders are incentivized to figure out a way out of this environment. It's a pretty challenging environment for everyone right now, and so they are coming to a less bad situation, modifying and extending these loans.
One of the things I've seen in the last 10 years and been amazed about, and Alex and I talk about it a lot, is the growth of private credit. Is private credit coming into the real estate space to maybe just find some opportunity here?
Yeah, it has been for some time.
Okay.
2015 private credit market share of total lending was probably 10% plus or minus. I'd probably say it's a little bit less than that. At the peak of the market, it was around 20% or so. But look, there is something to be said for private credit finding a home within commercial real estate. Look, there's 4,200 banks across the United States. Bank share is around 40% of total lending. There will be some banks that pull back for various different reasons. There has to be a home for those additional loans, and I do think private credit, if you have the expertise not to just underwrite the loans, but work out the loans when some of them inevitably go bad, there's a home for private credit. Do I think it's going to 50% market share? No. I sort of think the upper limits is around 20%. We're probably a little bit less than that right now, but there's a home for private credit.
So when we talk about the shoe and office commercial real estate not dropping, it sounds like maybe it won't drop at all. It'll just be sort of, John Tucker's doing the wave, and I don't really know why that is, but
let me get the confetti out.
Oh, we hit it.
Of course, it just came back down.
Of course, it came in number. For a moment, it was down 40,000.
The tick up counts.
Yes, it does.
That was amazing. The shoe's not maybe going to drop. It's just going to be worked out, and then no one's going to be sitting with really terrible loans forever.
So this is going to take longer than what was feared a year ago. A year ago, when you had banks coming under stress, I think a lot of people were fearing a quick collapse in commercial real estate lending. That has not occurred. This will be a slow burn over a number of years. I want to be clear, though, we are not calling for no distress in the commercial real estate market. I mentioned to you that property valuations are down around 20% right now. We are expecting them to be down peak to trough around 25 to 30%, so around 2/3 of the way through. The next leg lower is going to be rising distress. And by the way, that actually might be a contrarian bullish sign. So what do I mean by that?
Setting the bottom, maybe.
Exactly. Right. Exactly. It basically means sellers are finally capitulating and selling where buyers want to buy. That's a healthy contrarian signal.
See, Rich Hill, I think half of the real estate finance people in the business came out of Morgan Stanley. It's like a mafia there, those guys. They're all over the place. Rich Hill's
awesome.
one of them.
That was fantastic.
Rich Hill, head of real estate strategy and research at Cohen and Steers, joining us here in our Bloomberg Interactive Broker Studio, talking about the overall commercial real estate business, not just office and occupancy, but that's a one of. I can't wait to see what some of these buildings on 3rd Avenue, when they change hands, what the discount's going to be. I think it's going to be huge, like the Lipstick Building, just to pick one, an iconic building, but it's not an A property. I don't know. So anyway, all right, we'll get to that. All right, with our news in New York City, here's Michael Barr.
Thank you very much, Paul. Alex, John, the Justice Department and the White House today announced executive privilege over audio of a special counsel interview with President Biden. House Republicans today are weighing whether to hold U.S. Attorney General Merrick Garland in contempt. Garland announced the House move.
We have gone to extraordinary lengths to ensure that the committees get responses to their legitimate requests. But this is not one. To the contrary, this is one that would harm our ability in the future to successfully pursue sensitive investigations.
Special counsel Robert Hur issued his final report saying Biden knowingly stored classified information in unsecured locations, but the evidence found did not support bringing charges. Former President Donald Trump's hush money trial has resumed in Manhattan. His former fixer, Michael Cohen, is back on the stand for cross-examination. The defense is trying to undermine Cohen's credibility with the jury. Ukrainian President Volodymyr Zelensky says delay in U.S. aid to Ukraine has had a direct impact on the war along the northeastern border. Zelensky says Ukrainians are fighting to prevent any further Russian aggression to other countries.
We are fighting for us, for freedom, for democracy, but not only for our freedom and democracy. This is in the world. After Ukraine, if we will not win, if we will not stay, if we couldn't stay, so we'll be another country.
Zelensky spoke to ABC. Chinese President Xi and Russian leader Putin pledged to intensify cooperation against U.S. containment of their countries as they warn of growing nuclear tensions between rival powers. Putin is in Beijing. At the PGA Championship, Xander Schauffele leads for now at 4 under, and we'll broadcast live play-by-play after the U.S. markets close on Bloomberg Radio. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, if you missed the confetti, I'm not going to do it again. It only happens once. Historic day today. Dow Jones Industrial Average crossing the 40,000 mark for the first time right at 10:31 Eastern Time. So the Dow has more than doubled from March of 2020. That was the historic low. And so far this year, 18 record closes for the Dow Jones Industrial Average. But you know what? Since the start of the year, up 6.1%, so that trails the other major averages right now. It has come back down. Dow Jones Industrial Average still 84 points higher. That's good enough for a record. 0.2% higher, 39,993. S&P 500 right now, another record after yesterday's close, 8 points higher. That's up 0.2%, 5316. And the NASDAQ 100 also record territory, up 29 points. That's up 0.2% at 18,629. Meantime, Julian Emanuel at Evercore ISI throwing kind of some of the cold water on this. He says the reason for stock bulls right now to temper their outlook.
For us, the bottom line is 3.4% CPI, 0% retail sales, other signs of economic weakening. That doesn't say that the upside is unlimited as the market is trying to behave.
So Walmart helping the Dow across that 40,000 mark earlier. Right now, shares of Walmart up 6.5% after their earnings report. Mix of data today. Weekly jobless claims down, dropping to 222,000. Historically low reading there, and housing starts posting a smaller than forecast gain in April, while building permits, they fell. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
Thank you so much, John Tucker. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance through our lens of our Bloomberg Intelligence analysts. They cover about 2,000 companies in 130 industries all around the world. And it's not just Walmart, by the way, that's helping the Dow to 40,000. It's also 3M. They got a pretty bullish upgrade over at Vertical Research. And I like 3M. It makes everything that you use. It makes the sticky stuff on the back of Post-its. They take that and they use it for everything from planes to, well, Post-its. So not just a Walmart. Walmart's adding 25 points, but 3M's adding 20. It's that underlying real economy.
They used to
That's all I'm
be
saying.
officially known as Minnesota Mining and Manufacturing, right?
Sure, back in the day. I don't know. This is a John Tucker special.
When I started,
yeah.
when the Dow was under 10.
You know what? And what's really interesting here is the analyst at Vertical Research is Jeff Sprague. I've known Jeff for 40 years. He started out as covering the auto industry, and then he went over to the industrials. He was a sergeant, a tank commander in the U.S. Army back in the day. So, of course, we always refer to him as Sergeant Sprague.
Oh, my gosh.
And he is really good. And he left big Wall Street, set up his own firm, Vertical Research, like 15 years ago. It's just killing it. He's still covering 3M. He was there back when it was Minnesota Mining Manufacturing. So when Jeff Sprague, Sergeant Sprague speaks, I pay attention.
You pay attention. Okay, that is a great recommendation for that upgrade. That stock is up over 3%. Let's get some other details here on Warren Buffett and Berkshire Hathaway. So the news, we got the 13 Fs. We realize it's a backward-looking indicator, but it's always fun to get an idea and take away any macro from what Warren Buffett is buying or selling. Matthew Palazzolo is senior analyst at PNC Insurance. He joins us now in studio. All right, Matthew, tell us the highlights.
So there was a confidential holding for several quarters, and we had a clue that it was in financials. Didn't know what it was. There was only a certain number of financials that could even be that big that he might have been taking a position in that would have been big enough to hold confidential. So Chubb was kind of on the radar. I didn't think it was going to be the one, but it is. So they released that. They took $6.7 billion stake in Chubb, which I think amounts to about almost 6% or more than 6% of the company. So that was the big news. They sold a bunch of Apple, but we knew about that going into the 13.
And Paramount too.
They sold a bunch of Paramount.
Can't imagine why.
Yeah, they sold. I think I have the number here. 88% of their position in Paramount.
$6.7 billion. How does Berkshire Hathaway size an investment? Is it a percentage of the market cap of the company that they're looking at? Do they have a minimum? Like, I'm not going to do the homework unless I could put $5 or $6 billion into it.
Yeah, no, I mean, I think they look at it as a percentage of the ownership of the company that they can have. So a lot of the bank stocks, they couldn't own more than 10%, so they would kind of hover around Bank of America at 9.5%. So I think that's the way they look at it. In terms of capital, it's almost an unlimited thing, so they don't, they hope for investments big enough where they can put a lot of capital to work, but there's very few of them, honestly.
Okay, dumb question. What is Chubb?
Okay, so Chubb is, in our view, the best positioned global insurance company.
So insurance company buying another insurance company.
Yeah, I mean, you know,
A stake in.
Stake in. So Chubb is, I think, the cream of the crop in terms of their margins are excellent. Their growth, even though they're one of the biggest in the world, they're still growing at a nice clip. They have inroads in China that no other insurance company has. It was, interestingly, independent of insurance and Berkshire's insurance ownership, it's a company that you'd think Warren Buffett might want to own anyway. If you go back to the Charlie Munger line about you want to own excellent companies at fair prices rather than fair companies at excellent prices, I think not a comment on the valuation of Chubb, but something that really falls into that bucket.
Chubb, Chairman CEO Evan Greenberg. Why is that name familiar?
That name's familiar because his dad is the titan of the insurance industry, Hank Greenberg, 99 years old, former CEO of AIG, still working, and Evan has kind of taken over as that kind of titan of the insurance world himself.
That is such a cool story. Tom Keene had that nugget, as only Tom Keene could have.
As only Tom Keene could wiki that.
Yep.
Here I have a question about insurance companies, though. Like, isn't insurance companies like really a tough business to be in right now? Like, I'm just thinking specifically like climate change, all the geopolitical risks. Like, what's that like right now?
Always a tough business, but you've got some of the best operators in the game in Berkshire Hathaway and Chubb, right? Evan Greenberg, the CEO we're talking about, this company's massive, and he knows details down to the small lines of business. To your question specifically, Alex, the one thing, and Berkshire actually addressed this at their annual meeting in terms of climate change, is it's a risk, it's happening, it's making things more expensive, it's making storms worse.
Serious payout, okay.
Indeed. But in the insurance and reinsurance space, you can essentially reprice your product on an annual basis, sometimes on a 6-month basis, but usually on an annual basis. So they're not really locked into long-term things. They can leave certain markets if they see that it's getting out of control, which is happening in California. They can reprice a business, which happened in Florida. So certainly a risk, but something that the industry can manage.
All right, so the age-old question here is, nice little deal, $6.7 billion, but it got $189 billion sitting on the balance sheet. And again, the age-old question is, what does he do with it? And the answer really is
more of this.
More of these types of things.
More of these type deals. I think it's tough. I mean, look, I always, my ears perked up hearing this, and I thought, well, you know, Chubb's market cap's $100 billion. They've got $188 billion. You know, could they pull off some sort of behemoth elephant-sized deal that Warren Buffett was, you know, talking about wanting to do? I think it's probably nicer to think about rather than Chubb being part of the fold. We talked about Evan Greenberg. I can't imagine him necessarily coming in and working for someone else, maybe Warren Buffett, but if he could run this entire empire, insurance empire, combining those two, I think that would be an interesting proposition. I think highly unlikely, though.
Do you think that if Warren Buffett moves away from his day job in a more meaningful way, do his underlings still like the insurance business as much as he does?
I think so. So there's two guys, Ajit Jain and Greg Abel. Greg Abel's the heir apparent CEO. He came from the energy world. Ajit is in charge of all of the insurance businesses. I mean, I think Ajit's much closer to retirement than Greg is, which is part of the reason Greg's taking over. Insurance is the engine that runs, you know, Berkshire Hathaway, and I don't think it changes. It generates so much float. Even with Ajit gone, that replacing him at some point is going to be tough. They have another kind of heir apparent within who I think will do a good job, but I don't think they move away from that business.
Yeah. All right, Matthew, thank you so much. Matthew Palazzoa joining us there. He knows everything about the insurance company.
But he seems to have misplaced his razor. We got a little bit of an issue there. Yeah.
Wait, so they come into the studio and then you give them grief for how they look. This is a tough crowd, man.
Yeah.
It's all right. You don't have to shave for me, just for Paul.
He's trying to be Don Johnson.
Matthew Palazzo, Bloomberg Intelligence senior analyst, joining us. He covers all insurance things.
Yeah, and pulling up the holders, that's pretty cool. You got Vanguard, BlackRock, and then a big slug, Berkshire Hathaway, almost 26 million shares. Nice.
The Dow is over 40,000. This is Bloomberg.
company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom with a look at some of the company stories we're following. This is from the Journal. Let's start with Microsoft asking hundreds of employees in its China cloud computing and artificial intelligence operations to consider moving outside of China. This is tensions between the West and Beijing mount. Such staff, mostly engineers with Chinese nationality, they were recently offered the opportunity to transfer to countries including the U.S., Ireland, Australia, and New Zealand. The move by one of the biggest cloud computing and AI companies comes as the Biden administration is seeking to put tighter curbs around China's capability to develop state-of-the-art AI. The White House considering new rules that would require Microsoft and other cloud computing companies in the U.S. to get licenses before giving Chinese customers access to their AI chips. Authentic brand Sports Illustrated has brought on football legend Drew Brees as an investor in its ticketing business. Magazine brand looking to grab more market share. As part of the arrangement, Brees, he's the former quarterback for the Saints. He's going to serve as I got that right? He's going to serve as a strategic advisor and appear in marketing initiatives for Sports Illustrated tickets. Financial terms not disclosed. And girl power. Indiana Fever star Caitlin Clark's first regular season game as a pro basketball player. That drew an audience of 2.1 million viewers across 3 of Walt Disney's outlets. The game, which ran on ESPN2 cable channel and the Disney Plus and ESPN Plus streaming services, was the most watched WNBA game ever on ESPN platforms. She ended the night with 20 points, but they still wound up losing. Anyway, that's your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday Eve, everyone. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are live from Interactive Broker Studio right here in Midtown Manhattan. We cover all the top news in economics and finance, plus all the world and national news that you need to know. And for that, we go to Michael Barr. Michael?
Thank you very much, Alex, Paul, John. The Justice Department and the White House declared executive privilege over audio of a special counsel interview with President Biden. House Republicans are weighing whether to hold U.S. Attorney General Merrick Garland in contempt for refusing to hand over the material. At a gaggle with reporters today, Garland called the lawmakers' request illegitimate.
We're protecting our ability to continue to do high-profile and sensitive investigations, and we will continue to do that.
Special counsel Robert Hur has characterized the president as an elderly man with a poor memory. The prosecution's star witness is back on the stand at Donald Trump's New York hush money trial. Trump's trial resumed this morning in Manhattan with the defense cross-examining prosecution star witness Michael Cohen's testimony implicating the ex-president. Trump did not look at Cohen as he entered the room, gazing straight ahead. Political experts say President Biden risks losing a significant share of black votes in his rematch with Donald Trump unless the Democrats can craft a better message. Bloomberg's Amy Morris reports from Washington.
Bernice King, the daughter of slain civil rights leader Martin Luther King Jr., tells Bloomberg TV the Biden campaign needs to figure out how to reach young black people who are, in her words, very disgruntled right now with President Biden.
There are people in the black community who are feeling like not a lot has changed, especially economically in the black community, and I think many of them are being driven by that.
New polls by the New York Times and Siena College find that Donald Trump is garnering 22% from black voters in battleground states like Georgia. In Washington, Amy Morris, Bloomberg Radio.
Finally, Xander Schauffele is leading at 4 under at the PGA Championship at Valhalla. Tiger Woods, watch. He is 1 over for now. We will broadcast live play-by-play after the U.S. markets close on Bloomberg Radio. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Alex, Paul, John.
All right, thank you so much, Michael Barr. Here's a question for everybody. What would you do if we ran out of chocolate?
The devil, you say.
I mean, I would weep. You guys don't care.
Not critical, but what's your favorite candy bar?
Ooh.
I've got a strong opinion on this.
I don't know. I don't like traditional cheesy candy bars. I like the good old 97% cocoa kind of thing.
Goldberg's peanut chews for me.
Oh, really?
Okay.
Huh.
Don't hear that every day.
You don't hurt your teeth when you eat them?
Well, especially when you leave them in the refrigerator. You take them out. That's
Oh
how you
my
roll.
God.
Yes.
And then the teeth break. I bring this up because...
Well, I thought you wanted to know what my favorite candy bar was.
No, you wanted to know what yours was. So cocoa prices, as we know, have surged, right? They topped, they almost hit 12,000. They're come down a little bit, but what caught my eye today is that Pierre Andurand, he is a commodities guy. He made a lot of money betting bullish bets on oil. He came up and said you could see cocoa prices jump to more than 20,000 this year or next year. And he said the supply shortage is so stark, he sees a risk the world runs out of cocoa stocks.
And is this because there is a drought in parts of Africa where they grow cocoa?
That's a big one. So bad weather in West Africa. You got climate change in general, right? So maybe the places that were really good to grow cocoa yesterday aren't good today. There's been 2 disease outbreaks. And then he's also pointing to, and I didn't think about this one, a shortage of fertilizer because of Russia's invasion of Ukraine. And you need the fertilizer. And the combination of all of this could really deplete cocoa stocks.
Wow. I mean, you can't have a world without cocoa.
I mean, to be fair,
I'm not going to go that extreme.
I mean, it's not like I'm never going to have chocolate again. Like, I eat a lot of Lily's chocolate because it has low sugar and it's less calories, blah, blah, blah.
You do remember how the plants are fertilized, pollinated.
No.
But we'll,
How many times do I
Yes.
have to tell you this?
yes.
What? You haven't told me this once.
It's the fleas on the backs of wild boars.
Oh, you have said this. You have said this.
I can't believe you forgot that.
I'm so sorry. I don't know. What was I thinking? Anyway, a world without chocolate. Tucker, do you have a favorite chocolate?
It's just gonna go with Hershey's. You know,
All right, these guys. All right, coming up, we're going to talk about Deere earnings with Chris Ciolino. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, John Tucker wanted a markets voice to talk about the Dow breaking through 40,000. We got Norma Linda. It's her job. She's equities reporter for Bloomberg News. She's going to join us here. Chris Ciolino, Bloomberg Intelligence, is going to help us break down Deere earnings. How's the U.S. farmer doing? So we'll check it out. David Kudla, founder, CEO, and chief investment strategist at Mainstay Capital. He's always got some really good insight into these markets and where we're going coming up. So we'll check in with him as well. But let's kick everything off this hour with Mr. John Tucker. Any Bloomberg Business Flash, John?
And this flash being brought to you by BNY Mellon Insight, June 4th to the 6th in Nashville, Tennessee. Don't miss the essential event for the financial advice community. Visit insight.bnymellon.com. Yeah, investors powering the Dow Jones Industrial Average through the historic 40,000 mark and doing some of the heavy lifting. You have shares of Walmart. They were up close to 6%. Set a record after its earnings report. The Dow, which of course is price weighted as opposed to the S&P 500. That's what market cap weighted. Anyway, the Dow right now up 131 points. That's a rise of 0.3%. 40,038 on the Dow Jones Industrial Average. Asima Shah, Chief Global Strategist at Principal Asset Management, remains bullish of stocks at this point.
Although the market has been pushing out the expectations for rate cuts, I think the fundamentals, even if you were not to get rate cuts this year, the fundamentals for the economy are still so strong. And that certainly implies that earnings growth is going to remain pretty solid, and that should continue to mean that stocks are going to be boosted through the rest of this year.
And I'll just power through some of the individual shares. Deere reducing its profit outlook for the year. That's down 2.2%. Cisco Systems, heard from them earlier. They're down 2% right now, giving a solid sales and profit forecast. And Berkshire Hathaway unveiling its $6.7 billion stake in the insurer Chubb. Those shares 3.6% higher. Overall, the S&P 500 15 points higher. That's up 0.3%. That's a record, 53.23. The NASDAQ 100, that's a record, 62 points higher. That's up 0.3% at 18,659. Again, the Dow right now 40,030. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. You impressed Norma Linda's here. She was like, wow, like she's into this. John threw some confetti. It was very exciting.
I believe the jaw is dropped.
Yeah. Paul and I are like, yeah, whatever. All right, Nora, you're taking a look at the overall market.
Are you saying it's just another number?
I am saying it's just another number. Also, you know the argument, the Dow doesn't really reflect all the companies in the economy, yada, yada, yada. That's what the naysayers are going to do. But this is the moment where, like, my mother-in-law calls me and is like, what's going on with the Dow? Yeah. What should I do? Do I need to sell? It's one of those things. Nora, it's good to get your perspective on this. So are you guys talking about Dow 40,000?
I mean, there was cheering over on this side of the newsroom.
Wow,
I kid you not. Every other team was staring at us on the equities team as we're all cheering and hoorahing. But of course, you know, when we talk to different sources, it does seem as though some of these solid. The round numbers are a bit, I won't say arbitrary per se, but it kind of gives the bulls a little bit more ammunition and optimism, especially as we're thinking about these Fed rate cut bets that we've been seeing and talking about for quite a while here. And as John mentioned earlier, of course, the Dow is actually price weighted. So that means that changes in the highest price stocks have a greater impact on the overall index than price changes in the lower price stocks. So definitely of interest here today. And we're really just talking about, are we going to see it drop below 40,000 after this? Or
Yeah,
are we just
probably.
going to keep running onward? We'll see.
So in individual names, though, you're looking at Canada Goose. We were all about Under Armour, we're about Walmart. What's going on here?
Canada Goose. So I love this company. I mean, I actually don't own a jacket, a Canada Goose jacket. They're so expensive.
Oh my God, so expensive.
Yes.
But when did they come on? I mean, they were they just burst on the scene. It seemed like 5 years ago or something. Then everybody had it.
It does feel really recent.
Wasn't there? Again, it feels like within the last 5 years, boom, that was the coat everybody had out of nowhere.
Okay,
Everyone's walking around with it. Well, we are seeing shares of Canada Goose rising for their biggest gain since 2021. It's up as much as 25%, now pairing to about 15%. But this is after the retailer reported fourth quarter revenue that came in ahead of expectations. And of course, we know these jackets are super expensive. The company issued a new outlook, and it says that it sees slow growth in revenue, but higher profitability in fiscal 2025. That has investors enthused.
All right, this is for John Tucker. June 16th, 1986, my first day on Wall Street, the Dow Jones Industrials closed at 1,874.
Oh. How do you feel about that?
I'm taking credit for that 38,000 point move.
That is something.
Yeah, isn't that crazy?
It's like if you look at, that's why there's the whole idea of, you can argue whether or not how diversified you should be, but the case is you just own stocks for a while.
Yeah, that's what I'm telling my kids. Max out on your 401k on stocks. I'll talk to you in 30 years.
Yeah, exactly. That's what I tell my husband when he worries about when we get our 401k stuff and he's freaking out about 5%. I'm like, dude, you're not retiring today. It's going to work out.
Maybe he thinks he's
Maybe, I think that's more of the point. All right, what else are you looking at, Nor?
I mean, let's jump back to Walmart. Of course, retailers, as we're coming off of Canada Goose, retailers are really in focus. Now, this is after Walmart really reported a surge in terms of wealthier shoppers flocking to the store. I was looking it up. It doesn't seem like we have any Walmarts here in New York City, but as a Virginia native, that was my spot. It was either Walmart or Kroger, and it's funny. I think the closest ones are in Jersey. If I'm not mistaken.
You come down. I'm going on a store walk this Saturday. Tomorrow.
Okay.
Yes, Saturday, yeah.
Good for you.
Yeah.
Well, it says that it now expects the full year to be slightly better than its initial expectations. And it did see sales rise by 3.8% in this past quarter. So we really are seeing a bit of the wealthier class coming to this store to shop. And customers are pretty much prioritizing staples over big discretionary purchases. So that's still important to point out here.
All right, very good. Norma Linda, thank you so much. We appreciate that. Norma Linda covers equities for Bloomberg News. Deere is one of those names that reported earnings. And again, when I think about Deere, I think about it in the context of being a really good snapshot on where the U.S. farmer is in terms of their economic well-being. Chris Ciolino, he follows Deere. He follows all those industrial companies for Bloomberg Intelligence. He joins us here. Chris, what was your takeaway from Deere this quarter and the outlook?
You're right. It's all about the outlook. We expected them to cut their 2024 outlook. You saw that from their peers, CNH and AGCO. They both lowered their expectations this quarter. But the haircut this quarter for Deere was more than we had anticipated. They actually took net income down 8%. So we're looking at net income around $7 billion this year, which would imply earnings a little north of $25 a share, or roughly 8% below the street. And really, there's two things for the reduction in the outlook. One, farm fundamentals, farm economics continue to deteriorate, so we're seeing broadly weaker demand across the globe. And then two, they're going to have to underproduce retail demand here because inventories continue to pile up given the softer demand backdrop. So production will be down significantly in the back half of the year. But I think now the question becomes, is this cut going to be enough to destock the channel moving into 25?
Is it?
I don't think so, no, because I think we're going to see further degradation in the retail demand environment. The backdrop isn't particularly encouraging for farmers. I mean, we're still looking at lower crop prices. You have higher production expenses, interest rates, they're still quite elevated, so net farm income is going to be down double digits for a second straight year. On top of that, you have broadly weaker farmer sentiment. They went out and bought a lot of equipment over the last 3 years, so there's really no impetus to go out and start spending again. And this is an election year, so add another layer of uncertainty on top of that. So we I guess, really struggle to see a catalyst, at least in the near term, that's going to really accelerate demand.
Well, does that mean, is that good news for the John Tuckers of the world who want to go out and buy a John Deere tractor? Are they going to get a deal here? Are they going to get some competitive pricing?
You certainly can get a deal. We're starting to hear more and more about competitive pricing, particularly in South America, but there's too much inventory globally. We heard that from Deere on the call, at least particularly for North America. That seemed to be a change intra-quarter here where they're going to have to underproduce for the back half of the year. So both new and used, too much inventory. That being said, a lot of this equipment, even though it's sitting on lots, does come at a significantly higher price point than even just 5 years ago, given all the technological advancements.
So basically, this is still a cyclical business, and we haven't hit the bottom of the cycle yet. Do you have visibility on when we may do that?
It's a great question. No, I'm one in the camp that thinks that we're in a little bit more of a prolonged downturn. Historically, downturns in this business don't last 1 year. And if you look at, consensus expectations are for roughly flat sales and earnings for Deere and the ag equipment peers for next year. Historically, downturns last 2 to 4 years. We typically look at peak to trough declines north of 30%. We'll be down roughly 15% in terms of volume this year. Historically speaking, that tends to accelerate in year 2. So it really ultimately comes down to, I think, what are crop prices going to do? I think that'll be probably the early sign that maybe we're approaching a bottom, but we're looking at another bumper crop this year. Barring some adverse weather event, I think you're going to see continued downward pressure there, though.
Chris, what are the crops that you look at and investors look at to see whether it's going to be a good year or a bad year for farmers? Is it soybeans, corn? What do you look at?
So there's 3 that matter. It's corn, it's soybeans, and wheat. If you think about it in the U.S., those 3 crops alone account for roughly 55% of farmer cash receipts or farmer crop cash receipts, which are essentially farmer revenue. So those are the ones that really move the needle, particularly for the large, high horsepower equipment, which really drive the earnings power for Deere.